To go until the start of cash equity trading. I'm Tom McKenzie in London, and here are your top stories. Looking for direction, European stocks are set to open mostly in the red as traders gauge the health of China's economy. The IMF warns 1/3 of the world will fall into recession this year. COVID struggle. Xi Jinping warns tough challenges remain in China's battle against the virus, but signs emerge that infections may have peaked in some major cities. Plus, coming up short, Tesla's quarterly deliveries miss expectations despite offering rare incentives in the US and in China. Let's take a look at the futures then. After a day of gains across the European markets, very low volumes though, of course, because the UK was still on a holiday yesterday. Futures pointing to losses of 0.4%, so pushing back against some of the positivity of yesterday. DAX futures pointing low by 0.3%. Here's the open then. We'll just wait for that to come through across the main indexes. You're looking, of course, at markets now starting to price in when it comes to the ECB. Around 150 additional basis points. You're at 250, 2.5% from the European Central Bank, 2%, I should say. Market's expecting another 150 basis points by the middle of this year. Comments as well from Mike Burry of Scion Capital, suggesting that he thinks that inflation is close to peaking or will be peaking in a bit up in the middle of next year. Again, the China data, though, so consequential in terms of where we get to, in terms of the evolution of that economy. The data on the ground suggesting cities like Guangzhou, really important, Chongqing, Shanghai and Beijing, that activity is starting to pick up. You had the China Beige Book, of course, pointing to the data for the fourth quarter, suggesting there's contraction there, but the data now coming through on a weekly basis, suggesting that certainly in terms of mobility and transport, that is starting to pick up in some of the major cities. Across the Hang Seng Enterprises Index, then, you are seeing some gains. Across Asia, in fact, you saw some pretty positive momentum in the session today, and across these Hong Kong or Chinese shares, companies listed in Hong Kong, gains of almost 2%. Futures in the US painting a slightly different picture to what is evolving here in Europe, then, gains of 0.7%. And the Japanese yen really is a story for the day, and I know Mark Cudmore is going to be giving us more detail on that. 130 now on the yen, a gain of 0.5% as markets start to position for a breakdown in terms of that yield curve control from the BOJ. And spot gold getting a leg up at the start of the year, gains of 1.3%. So the yen and gold both rallying. Of course, the haven bid and expectations that maybe you get a softer dollar would be good for the yellow metal. 1,847 per troy ounce. That is a gain of 1.3%. Let's get over then to Bloomberg MLive managing editor Mark Cudmore. Mark, I know you're looking at China PMIs, but I think you're also taking a little look at the yen as well.
Yes, absolutely, Tom. Good morning to you. I'm giving you two quick takeaways from the Asia session. One was this China PMI that came out over the weekend. Services PMI for December was the second worst month on record, going back a little over 15 years. The only month worse was for February 2020, at the first kind of wave of COVID in China, when they were just worried about permanent lockdowns, did not know the extent. So that's pretty negative, but markets seem to be rallying through it and looking beyond it. And maybe they've got good reason. Maybe we've already seen the worst of this wave, as Xi Jinping has suggested, as subway data seems to be implying. People seem to be starting to moving again. And if we are beyond the worst, it can rebound very quickly. It took us only 2 months from that February 2020 low print to get back into positive territory. The red dotted line there showing the neutral territory in this diffusion index. So looking pretty bleak, but markets looking beyond it, and they might be right too. The other chart I want to show you very quickly is dollar yen. It's unrelated, but it was the other big takeaway for the European session. Now, dollar yen basically broke down very, very clearly in Asia. You can see this. This is the double low from early August and back in December. I think it was around 130.40 was around the level. We broke way down below there today. I think the low in the day was 129.52. I think this might be a false break. It's very hard to argue with this story. It's a very clear technical picture. It's one of the most consensus trades, probably the most consensus FX trades from banks out there for 2023. Long yen, short the dollar. Sell dollar yen for every more. Every single guest tells you it's got a good narrative. The BOJ has already started conceding. They're going to capitulate full time. They're going to tighten their monetary policy, and that's going to support the yen. The problem is FX traders are getting way too far ahead on this story because if the yen keeps on appreciating, that's a disinflationary impulse and will make the BOJ be more resolute in easing. I think, controversially, this dollar-yen break down to 129.52 is a false break, and I think over the next month or two we'll see dollar-yen instead head higher.
Oh, there we go. Controversy from Mark Cardmore. 130 currently on dollar yen. Thinks that break to 129 has gone too far, went too far, for example. Bloomberg M Live managing editor Mark Cardmore with the China PMI's analysis and also, of course, the prospects for the yen as investors step up their bets against the BOJ's ability to maintain yield curve control. Mark, thank you very much indeed. Now back to that China story then. Chinese President Xi Jinping has warned the fight against COVID will be tough in his first comments since Beijing's pivot away from its zero COVID policy. It comes after data released over the weekend showed China's economy ending the year in a slump, as Mark was saying, with a slowdown in manufacturing worsening. Let's bring in then James Athey, Investment Director at Aberdeen. Good morning, James. Happy New Year. Thank you for joining us on the show this Tuesday morning. To what extent should we start to factor in then China as a major catalyst for potential growth in 2023?
Morning, Tom. Yeah, and Happy New Year to you too. Definitely, I think China is one of the big macro stories for the next few months and probably for the whole of this year. I do, however, think that it's a more complicated, more nuanced, and more difficult to analyze story than potentially some investors consider at the moment. Of course, China reopening on the face of it is quite simply a growth and risk sentiment positive. And certainly, I think that is the first order reaction that many market participants will go with. But of course, if it were to be the sort of usual China recovery story, we would see that playing out with quite an inflationary impulse. And that would complicate, if not really worsen, the problems for other central banks around the world. And if we see them reacting with a more forceful and more hawkish policy outlook, then that could very well lead to worse outcomes for growth outside of China. So it's going to be a difficult one. And certainly, I think the early stages are likely to be still, challenged by the spread of the virus.
And with that inflationary impulse, because that is a key conundrum, isn't it, for this year out of China, how would you expect that to kind of percolate through the system?
In much the same way as the first two shocks did, really. It's a cost push shock, so it's going to happen first and foremost by markets front-running expected increases in demand for key commodities, and that's going to push prices up in financial markets, and those headline jumps in key inputs into many manufacturing and economic processes elsewhere will then percolate with second and third order effects, dragging up other aspects of the inflation basket with a lag. And of course, then if firms in the service industry respond to this with price increases themselves, you get this long tail of inflation as we have seen through 2022.
James, how is that a way to play the China story? You want direct exposure to commodities, or as you look, and I know you have deep insights into the credit space, with the easing of restrictions around real estate in China, is credit starting to look a little bit more attractive in that world?
Yeah, I'm not on the property side. I'm still a little concerned. There is obviously a difference between some of the sort of sledgehammer-esque policy steps that China has taken over the last 18 months or so versus what we are seeing today. Whether that is sufficient really to bring the property market back into something close to equilibrium, somewhere where you'd want to deploy capital, I'm still a little bit skeptical. But given that the broad credit spectrum and particularly high yield credit in China has been all dragged lower by the problems in property, I think for an informed investor who can pick and choose some of those companies that maybe are babies thrown out with the bathwater, I do think there will be attractive opportunities. Commodities is the traditional way of playing a China growth rebound. I would openly question whether that should be as effective an implementation for that trade, just given the shifting narrative, the shifting policy stance coming from President Xi post the last Congress at the back end of last year. We are not seeing the same growth at all costs model, and certainly the Chinese authorities, I think, still have concerns around leverage. They would like to see the consumer leading the economy. I think that's a difficult transition. So even after all of this reopening, I'm still cautious that China is going to be able to achieve the sort of 5.5% growth target that it has over the medium term.
Yeah, they have struggled, haven't they, to revitalise, or at least to get the consumer playing a larger part of that economy. They've struggled with that for a number of years. So maybe a more nuanced approach when it comes to how to stimulate that economy. When it comes to the other big story of the day, of course, James, is the yen. And we heard from Mark Cardmore, MLive managing editor, saying that maybe markets got ahead of themselves with 129, currently at 130, a gain of, what, 0.3%. How much more room for upside is there for the yen, or has it peaked at this point?
Yeah, but I think Mark makes some really great points, to be honest. We've been bullish the yen for quite some time. That has been a painful trade, sort of in the latter stages of that rally up to 150 and above. But we just increasingly felt that the higher it went, the more asymmetric it would become. Honestly, Japan has been a wonderful asymmetry trade. And as an investor, there's nothing really more attractive, nothing that can be more lucrative than something which feels so very asymmetric as the rates and FX outlook had increasingly become. So we've been short JGBs and we've been long the yen for a while. We actually removed our dollar yen short in the aftermath of the big move down to 130 and a half-ish, as Mark has already described, for exactly the reasons really that Mark talks about. It feels like there are a lot of sort of Johnny-come-latelys, shall we say, to the stronger yen story, and it felt like it may be a bit of a bear trap. We do continue to run long yen on some of the crosses, and we think actually they could become more attractive trades through this year, particularly versus risky currencies like sterling and the Aussie dollar. So we do think there is still more upside for the yen, not just from Bank of Japan policy shifting, but because the yen, we still believe, will play a traditional risk-off flight to quality role when we inevitably see equity markets, particularly in the US, more accurately reflecting the economic outlook this year.
Really, really interesting on yen. Maybe some more upside there through some of the other crosses. James Athe, Investment Director at Aberdeen, very pleased to say staying with us. We'll get more of his calls in the next few minutes. Coming up, Tesla deliveries for the last quarter. Well, they missed estimates, despite it being another record year for that company. We have the latest news on the electric car maker shortly. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. It's the first jobs report of the new year.
The labor market has not cracked.
A lot of that's a function of labor shortages.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Can you walk us through how the Federal Reserve conversation has reset?
We're still seeing a strong economy, so the Fed has to do more.
Why are people so confident that there is going to be some massive deceleration?
I just don't see the evidence.
This could go a lot of different ways.
The December jobs report, Friday on Bloomberg Television and Radio.
We expect 1/3 of the world economy to be in recession. For most of the world economy, this is going to be a tough year, tougher than the year we leave behind. Why? Because the three big economies, US, EU, China, are all slowing down simultaneously.
And that was the IMF Director, Kristalina Georgieva, giving a pretty dire forecast for the global economy this year. Meanwhile, Michael Burry, the Cyan Asset founder, also gave a stark forecast. He said inflation may peak at some point in the next year, but there may be another inflation spike later this year, also warning of a recession in the second half of next year in the US. Still with us is James Athey, Investment Director at Aberdeen. I want to loop back to the IMF's comments, James, and get your views on how this global economy evolves. So a third of the global economy in recession this year. That is the forecast from the IMF Director General. How do you expect the global growth picture to evolve then?
Yeah, I'm assuming she's referring there to a sort of population split because as she described, that actually the three biggest economies are likely to be really suffering. And if you just take the EU and the US, which I think are highly likely to be in recession, you've got a pretty significant chunk of global GDP right there. So I very much expect that we're going to be seeing recessionary conditions across much of the world, to be honest. Because the tailwinds which took us to the heady heights and meme stock madness of the last 12 to 18 months have all become significant headwinds, and the monetary tightening that we have seen over the last 12 months or so, not just in the US, but everywhere. When the ECB is hiking by 75 basis points, you know you're in a very different world. That monetary tightening is not even really being felt just yet, and I think that will increasingly be weighing on activity through the first half of this year. So I really do think we could see quite a protracted recession because, again, while inflation is likely to come down, and I do think it will, the response from central banks will not be able to be as rapid or as aggressive as we've become accustomed to because inflation is still going to be a binding constraint, I think.
So to that point, James, and this is the simplistic but important question, and to that point, do central banks ultimately, do they blink in the face of those recessionary forces?
Yes, I don't think they will blink at the first signs of genuine recession. I think really we need to see much more labour market weakness than we've had. And I guess that's where I've been most wrong in the back end of last year because the labour market has been so robust. But if labour market conditions remained as strong as they are today, I think the response would be much more delayed. My base case is that we see significant labour market weakness at the same time as we see significant disinflation. And so, yes, central banks will respond with rate cuts. That might not be immediately to zero, and I certainly think, and I certainly hope, to be honest, that they are slower to utilize their balance sheet. But I do think that we will see monetary easing this year because recessionary conditions plus a sort of 5 or 6 point disinflation in key inflation indices is pretty significant.
James, before we let you go, what are your key calls for 2023? I know the UK is in the mix. I'm seeing the FTSE 100 up 1.4% in today's session. What else are you looking at?
Yeah, I mean, ultimately, I don't like risk assets here. I think we're going into recession and they look expensive. So I don't really want to be positioned cyclically at all. So defensive versus cyclical in many forms. And that really means bonds versus equities. And bonds are very cheap versus equities in a way they haven't been for quite some time. I think within the equity space, the US still looks way, way, way too expensive, whereas places like Japan and UK look much more reasonably valued. And I think there's a dollar depreciation at some point this year, probably a significant one. And so potentially owning those two indices, currency unhedged versus US equities, looks a pretty attractive position. Within fixed income, I'd prefer safety to cyclicality, so I'd be high up the quality spectrum owning rates versus credit and possibly earning IG versus high yield. I think EM local is incredibly attractive because they've had a much more credible monetary response last year, and so there's some really high rates and really high real rates on offer. And even in some countries like Mexico, where policy has been much more credible and orthodox than most of the rest of the world. In FX space, we do still like the yen. We also like the US dollar for now because we think it has one last leg higher when we see risk assets reflecting the cyclical outlook more appropriately. But maybe later in the year, I think there's a decent dollar depreciation coming.
Okay, there are your calls from James Athey, always excellent, Investment Director at Aberdeen. Thank you for kicking off the new year with us, James. We'll be speaking to you again, no doubt, in the next few weeks. Thank you. Now, Tesla delivered fewer vehicles than analysts expected last quarter. That's despite taking the unusual step of offering hefty incentives in its two biggest markets. With us to dive into the figures then is our global business reporter, Hee-Jin Kim. Hee-Jin, tell us more about these delivery numbers and what they tell us about the year that was for Tesla.
Sure. So Tesla delivered about 405,000 vehicles in the last 3 months. And as you mentioned, there was actually below the analyst estimates about the 420,000 EVs. And actually, the company even missed its own targets for sales. It promised, Elon Musk promised about 50% increase in the sales last year, but he made just about 40%. So the fears, worries about what's going on in Tesla. Everyone is saying that Tesla seems to be struggling, especially in China, where the local brands like BYD is doing such a great job.
Yeah, the challenge from the competitors in that important market for Tesla. Hee-Jin Kim, our global business reporter in Seoul. Thank you for the latest numbers. A miss there in terms of the expectations on delivery. Still a 40% gain year on year for that company. Now, coming up, Atos shares jump on reports of talks with Airbus about the sale of a minority stake in its Ividian cybersecurity business. We're going to bring you the movers next. This is Bloomberg.
COVID has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
Welcome back to the Open Happy New Year on this Tuesday. We are 23 minutes into the European trading session. Currently gains of 0.9%, a solid session this Tuesday in Europe. Futures in the US also pointing higher. Let's get the Bloomberg Business Flash now with Laura Wright. Laura.
Good morning, Tom. Tesla deliveries fell short of estimates in the latest quarter, despite offering large discounts in the US and China. The electric car maker handed over just over 405,000 vehicles to customers, below consensus Bloomberg forecasts for around 420,000. While the total was a record for Tesla, the firm came up short of its goal to grow deliveries by 50% last year. UK rail workers will walk out for much of this week, disrupting the usual return to work after the holidays. Unionised railway staff will strike for 5 days from Wednesday, with nurses and ambulance drivers, among others, also due to take industrial action later in the month. The protests stem from growing anger over the tightest cost of living squeeze in decades. China Evergrande Group has vowed to repay debt in 2023 after again delaying announcements of a much-anticipated restructuring plan. In a New Year letter to staff, the property developer's chairman says it's a crucial year for Evergrande to deliver residential projects it pre-sold. He added that construction resumed last year for all of its more than 700 real estate sites. SpaceX is reportedly raising $750 million in a funding round that values the company at $137 billion. CNBC says Anderson Horowitz will be the lead investor, having previously backed the space transport company run by Elon Musk. Last month, sources told Bloomberg SpaceX was offering insider shares at $77 apiece, valuing the company at about $140 billion. That's the Bloomberg Business Flash. Tom.
Laura Wright here in London, thank you very much indeed. Let's have a check then on some of the individual movers, and you're seeing a very solid rally in the oil producers, the likes of Shell and BP. That is propelling the FTSE 100 up by 1.5%. Here's what's happening at Shell then, a gain of 4%. Yes, oil is up in the session, but clearly there is some estimation that demand for oil is going to increase, possibly around the data story out of China in terms of mobility. But currently Brent is up 0.5%. Atos, this is a company listed in France. Double-digit gains for this company yesterday in terms of the stock movement, building on that today with another gain of around 1% on the back of reports that it may be closing in on a deal with Airbus around investment. And then Bruntag gaining 5%. This is the world's biggest distributor of chemicals after announcing that it's walked back from talks to potentially buy its US competitor Univar. So that has ended those conversations, those preliminary talks, and investors rewarding the company on the back of what would have been one of its biggest deals. Bruntag up 5% after ending those talks. Now, coming up, China's economy ended the year in a major slump as COVID infections surge across the country. More on the economic outlook then for the world's second largest economy. That is next. This is Bloomberg.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in another person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. Looking for direction, European stocks open higher. That's as traders gauge the health of China's economy. The IMF, meanwhile, warning 1/3 of the world will fall into recession this year. COVID struggle. Xi Jinping warns that tough challenges remain in China's battle against the virus, but signs emerge that infections may have peaked in some major cities. Plus, coming up short, Tesla's quarterly deliveries miss expectations despite offering rare incentives in both the US and China. So we'll check in on the markets then. European equities building on the gains of yesterday. The UK reopening with a bang, certainly propelled by what was happening in the oil space. The likes of Shell and BP driving the FTSE 100 higher. Gains of 126 points or 1.7% for the FTSE 100, which, of course, for the context last year was a relative outperformer. The likes of James Athey over at Aberdeen saying he still thinks there's more upside for UK equities within this recessionary environment. The European benchmark up 1%. The DAX over in Germany gaining 108 points, 0.8%. Markets pricing in 150 basis points from the ECB by the middle of this year. In terms of the data, we're looking ahead to the FOMC minutes out of the US, but the data when it comes to the jobs and non-farm payrolls, of course, consequential on Friday. Let's switch it over, see how things are playing out across sectors. I talked about the energy space and the gains there. Travel and leisure also doing well, 2.3%, and that will be feeding in the FTSE 100 as well. Retail sector gaining 1.6%, financial services, real estate, and there is energy within the mix there, up 1.6%. Every single sector gaining at the start of this year, again, building on the plus 1% upside that you saw across European equities of yesterday. So the new year starting off on the front foot, but for how long? China, part of that mix, of course. Yes, it looks like the last quarter, according to the China Beige Book, was pretty grim in terms of the slowdown there, contraction in the last quarter, according to the China Beige Book, but the on-the-ground data, particularly around mobility, suggesting things are picking up. So to China, ended the year in a major slump, of course, as business and consumer spending did plunge in December, with more disruption likely in the first few months of the year as those COVID infections surge across the country. And we're seeing some of that surge starting to peak, arguably, in some of the main economic hubs, the likes of Guangzhou, but also Shenzhen, Beijing, and Shanghai. And that is adding to some optimism. You saw that ripple across the Asian equity space this morning. Let's bring in Annika Trion then, Chief Economist at Van Lanschot Kempen. Annika, good morning. Happy New Year. Thank you for joining us. What is your sense, then, of the economic growth impulse that we can expect from China? The growth impulse and the inflation impulse for 2023 out of the world's second largest economy?
Good morning, Tom. Well, it's a two-pronged effect. So on one hand, you've got easing supply chains, which is massively important for the easing inflation story, which we've all been harping on about. On the other hand, you're lifting the lid on one of the world's largest demand drivers. And let's remember that we've had a global inflationary problem without the participation of one of the world's largest demand drivers. So it's a twofold story, and what we know for sure is that the reopening story of China will be complicated, will be bumpy, as we've seen thus far. So very hard to predict.
And how constrained do you think officials will be in Beijing when it comes to the stimulus, the need to stimulate this economy as they reopen? We were speaking to James Athey of Aberdeen early in the show. He said they're not going to go back to the growth at all costs model.
Well, indeed, and I mean, and it is quite remarkable because China as a nation is not a nation that you would think would be missing so largely on its own growth forecasts. So the fact that they were actually willing to take the pain, they were willing to not, go out and do what many other nations have done, which is massive stimulus into the economy, is definitely a telling sign. And that's why when we think about global growth, we should consider global growth without the reliance of the growth factor of China, which is something quite new for us, at least in the last decade.
And certainly we heard that warning from the IMF as well around the global economy, potentially a third of the global economy facing a recession this year. What is your expectation of how growth evolves? How concerned should we be about a recession within the major economies this year?
Well, Tom, the funny thing is, obviously, every major house has come out with its 2023 outlook. And the consensus around recession is just alarmingly high. I mean, this is probably going to be the most anticipated recession we've actually ever come across, at least in the last 5 decades. So taking that into account, it does make the picture rather tricky, because on one hand, we all know what's coming. There's two things that we know as a certainty. Number one, the inflationary pressure is easing, whether it's because of base effects, whether it's because of energy prices, supply chains, etc. The other thing we know as a certainty is we've surpassed the peak in terms of rates of interest rate increases. In fact, it's gone so far that the analysts' expectations on terminal rates, almost 5% in the US, 3% in Europe, etc., perhaps it's gone a leg too far. So that's what we already know in the markets. I think from a positioning perspective, the two things to take into account are we're likely to see a longer period of higher inflation. So going back to what it was pre-COVID is probably a step too far. And I think the other point is looking at earnings expectations in the equity markets, looking at multiples in the equity markets. This is not a moment in time that we feel comfortable about stepping in at this stage.
Well, on that point then, the European Stock 600 trading at around a little under 12 times forward earnings, below the average of 14.5 over the past decade. That doesn't signal an opportunity for you at this point.
Well, it certainly screens cheap. And again, talking about the sentiment, if you look at the surveys, the sentiment around European equities has always been rather poor over the last 10 years. But I mean, it's really, really all-time lows. The issue is, if you think about a typical recessionary environment, it's odd. On one hand, every pundit out there is talking about a recession looming in 2023. On the other hand, earnings expectations, it's quite typical in a recessionary environment for earnings to be down around 15%. That is absolutely not what we're seeing in terms of earnings estimates in the equity markets. Analysts are still going for sort of flattish year-on-year growth, earnings growth. And the point about Europe has benefited from the strong dollar over 2022. That effect has to normalize. And going into the actual businesses and, the fact that we're coming off all-time high earnings, all-time high margin levels at corporates, that's something that needs to be normalized first before getting excited about buying into the industry, buying into the sector as a whole. Single securities, however, is a different ballgame.
Okay, so maybe you need to get all grassroots, do your homework, and pick those individual securities, those with strong balance sheets, is the argument from many. When it comes to the energy, if we continue to focus on the European stocks complex, Anika, and we look at the energy read across, we are seeing those kind of milder weather conditions, whether it's here in Europe, the US, even in Asia as well, and then gas prices softer again today. To what extent is that going to provide some relief? Should investors be working that into their models? Or would that be getting ahead of ourselves, getting in front of ourselves in terms of the complexities of this energy challenge?
Yeah, well, Tom, I think that's been the largest positive surprise over the last few months. If you look at the level of gas reserves in Europe, it's remarkably high. It's above the 80%. And that's quite amazing, considering the fact that they've restricted so much in terms of Russian supplies. Obviously, they've benefited from a very mild autumn. We've benefited from other, alternative energy sources. And if the weather pans out to be okay without extreme situations, the fears around energy rationing could be behind us. So that's definitely something to bake into the models. And in terms of, the recessionary outlook for Europe, that could definitely shift the balance from, a heavy recession towards a more mild recession. So that's extremely helpful. But again, looking at companies, earnings, margins, especially at the group of businesses that don't have the best, industrial positioning, that don't have the best pricing power, there still needs to be normalization applied to the models.
When does technology look attractive to you, do you think?
Yeah, so that's the funny thing. And I think we really have to shift in 2023 from overarching. And the same goes for energy. So we all know energy has been phenomenal over 2022. Well, if you actually dissect the term energy into the different businesses within there, you do see quite large differences. I think the exact same thing applies to tech. What is the definition of tech? And you're talking about the type of businesses, again, what the business models are, what are the nature of the cash flows, and more importantly, given the fact that inflation is likely to be higher for longer, not at these elevated rates, but probably not going back to the world we've come from a few years ago, the discount rate plays a crucial role. So if you're talking about a tech business whose cash flows are very, very far out projected into the future versus a tech business which is more established, already generating cash flow, the valuation difference becomes quite exponential. And that's why I think, to your point, it's time for grassroots. Not everybody likes it. It's a lot more work. It's harder work. But that's actually how, that's how the world of investing was probably designed to be in the first place.
Okay, got to roll up our sleeves. Anna Catrion on the prospects of higher inflation for longer. Chief economist at Van Lanschot Kempen, with a background, of course, in equities as well. Thank you very much for those insights, and have a great rest of the week. Coming up, rail pain. UK workers are set to walk off their job for much of this week, once again, adding to the government's troubles. More on the strikes next. This is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
If I had to choose one market to invest in, it would be the UK over the next year. The UK economy this year in 2022 has probably done better than almost all of its peers.
In the UK, we have got some phenomenal talent.
We have phenomenal talent here. We really do.
I regard the outlook for the UK as being better than most commentators would suggest for next year.
What this year has shown us is that the business community loves stability.
The cost of doing Brexit is now baked into everybody's thought process.
We will get through and settle inflation down. It will take some time, but all of that is within our control.
We're going to do better than the Eurozone by quite a margin, and possibly better than the US.
Leo, some prominent investors on the UK and what opportunities and hazards they see in 2023. Sticking with the UK, there is more pain ahead as rail workers plan to walk off the job much of this week. It is, of course, likely to hamper travel across the nation and add to the troubles piling up for the Prime Minister Rishi Sunak and his government. For more, let's bring in Bloomberg's Lizzie Burden. Lizzie, how is the government handling these strikes? They keep coming across multiple sectors, amongst multiple parts of this economy. Are they engaged at a ministerial level?
Well, new year, not a lot's changed in terms of how the government's handling this. They're still sticking to this tough line. We heard from the Defence Secretary, Ben Wallace, saying that the government isn't going to be held to ransom by the unions as it was in the 1970s. But the risk for Rishi Sunak is that these strikes continue. The Guardian warning they could continue till April today, and that they paralyse the UK to the point that it's like the 1970s, which is like when Margaret Thatcher was brought to power. So despite Rishi Sunak's imitations of Margaret Thatcher's stance, we're expecting to have 5 days of rail strikes to start the year. That's going to hamper retailers' ability to maximise the January sales. It's going to mean that more people will work from home. And I understand that that's a major concern for the Chancellor, Jeremy Hunt, not just now, but throughout the year, because, of course, it holds back growth. But really the overriding concern among Treasury ministers that I speak to is they don't want to capitulate to the union's demands now, because more could follow as inflation stays high through 2023.
So for now, no backing down from the government on these strikes. Key, of course, and central to the in-tray for the Prime Minister. What else is in the in-tray for Rishi Sunak for 2023?
Well, the same macro themes as elsewhere, inflation and recession, and indeed how they can tame inflation without stoking the recession that the Bank of England says we're already in the UK. The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet. And despite the optimism of all those CEOs we heard there was an FT survey of 101 economists who said that the UK's recession is going to be longer and worse than any other G7 country. The words they were using were grim, miserable, bleak, so a very different picture. And that's what's going to shape the agenda politically for Rishi Sunak. We know that the Conservatives have to call an election by January 2025 at the latest. But at the moment, the poll gap between Labour and the Conservatives, according to some polls, is 26 points. So the Tories really need to prove that after 12 years in government, they're not tired. They've got the talent, the ideas, and the unity to deserve another term. And two of the big opportunities to show that will be, first of all, the budget on March the 15th to show they're really serious about growth. And secondly, in April, the 25th anniversary of the Good Friday Agreement. If they can deliver a compromise on Brexit, they can show that they're serious about the stability that, as you heard from Darktrace's CEO there, businesses so desperately crave.
So finally, possibly later this year, closing that gap around the Northern Ireland Protocol, which has been such a bugbear for that Brexit agreement. So the politics is there, the monetary policy, the BOE, given the challenges that are around this economy, what is the BOE looking ahead for this year? And how much of the hard work is going to be done by a slowing economy? Are they in a position to start rethinking these hikes?
Yeah, you've hit the nail on the head there. So in December, we already saw the Bank of England slowing the pace of hikes to 50 basis points, like the ECB and the Fed. In the months ahead, you might see more of a divergence between the major central banks in terms of how they slow the pace of hikes and at the point at which they pivot. But if you look at market pricing for monetary policy at the moment, they're expecting the bank to hike to between 4% and 5% this year. What's common to all the major central banks is, first of all, that the decisions are meeting to meeting, data dependent, and secondly, that the monetary policy committees are deeply divided between, on the one hand, those who want to focus on inflation with aggressive tightening, and on the other hand, those who are focused on growth and as you say, very aware that we're hiking into recession and that recession in itself has the power to control inflation.
And arguably, as you well know, you've reported on, those divisions are most acute within the MPC of the BOE. Lizzie Burden, thank you very much indeed on the look ahead for not only the BOE, but also, of course, the Prime Minister of the UK, Rishi Sunak. Let's get the Bloomberg Business first word, I should say. First word news with Laura Wright. Laura.
Thanks, Tom. President Xi Jinping has spoken out about China's COVID pivot, saying tough challenges remain in the fight against the virus. In a New Year's address over the weekend, Xi said the country is in a new phase of COVID control and has adapted after following a science-based and targeted approach. IMF Managing Director Kristalina Georgieva says a third of the global economy will face recession this year. In an interview with CBS, Georgieva said 2023 will be a tougher year than the one we leave behind. She says the US, the EU and China are all slowing simultaneously, with the outlook for emerging markets even worse. Moscow's defense ministry says a Ukrainian strike on a Russian military facility in the occupied east has killed 63 troops stationed there. Ukraine, meanwhile, has warned that Russia may launch more attacks over the Orthodox Christmas holiday later this week. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom.
Laura Wright here in London, thank you very much indeed. Coming up, Sweden's housing market rout continues with real estate downturns in Canada, Australia, New Zealand and here in the UK. More on that next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Open. We are 53 minutes into the European Trading Open this Tuesday. Happy New Year. A bit of liveliness now across these markets. Gains of 1.4% across the European benchmark. Here in the UK, look at that, just crossing briefly above 7,600 before edging back down. But you're seeing gains there of almost 2% for the FTSE 100, driven higher by the likes of BP, Shell and Rolls-Royce, gaining 5.6% within the FTSE 100. The DAX over in Germany also posting some pretty decent numbers, gains of 129 points after the upside that we saw across European equities yesterday, despite the thin volumes. And the Bloomberg Dollar Index up 0.7%. That is having a recross to the yen, which at the start of the session was coming out the gates very strongly indeed, but now has given up the gains, currently trading at 130 for the Japanese yen as the Bloomberg Dollar Index comes in stronger. So some movement here, optimism, risk on when it comes to the equity markets, but the dollar is certainly bid. Let's get back to what's happening around the housing market globally then, with a focus initially on what's happening in Europe. The drop for home prices in Sweden continued unabated in the last month of the year. Prices are now down almost 17% since a peak in the spring. And Australia's housing market suffered its biggest annual decline since 2008. That was last year, as sharp interest rate hikes sapped buying power. Joining me now is Bloomberg's John Strebek, who is across the UK economy, but also broadly what is happening in housing as well. And John, why have Sweden and Australia and other markets been hit so hard? How much of this is all about the interest rate hikes that we've seen over the last 12 months?
I mean, it's pretty much all about the interest rate hikes that we've seen over the last 12 months. And the thing that kind of pulls these markets apart, and this includes places like Canada and New Zealand and other quite high-profile examples, is that they're all particularly vulnerable to higher interest rates. And there's a couple of reasons for that. So one reason is that their mortgage markets have a higher proportion of variable rate loans or short-term fixed-rate loans. So that means that rising central bank interest rates are passed on rapidly to consumers. Sweden's particularly a good example of this. I mean, the share of kind of variable interest rate loans is around about 70 to 75%. So that kind of any interest rate rise by the Swedish central bank basically feeds straight through to mortgage costs. So that's one reason why Sweden's been hit so hard. Australia's got a slightly larger proportion of fixed rate loans, but a lot of them are due to come off by the end of next year. So again, there's this vulnerability. But on top of that, there's another factor, which is that consumers in all of these markets are already very highly indebted relative to their history. So they've got very high debt to disposable income ratios. That's partly because several of these markets didn't see a big crash in 2008. And so as a result, kind of house prices largely continued to go up. Banks kind of continued to lend money out. And so you've got consumers in a more vulnerable situation than perhaps they are in markets that were hit harder than 2008.
So John, what is the recross to the UK then, which of course was hit hard in 2008, 2009?
I mean, there's actually some good news for the UK on this, in that we are in slightly better condition than, for example, Sweden, say. So can I get our household disposable income to debt ratio, that kind of peaked in 2008. So while it's relatively high, it's lower than it was back then, and it's certainly a lot lower than Sweden, for example.
John, we've run out of time, John, but we appreciate the insights looking at the housing market for us. Bloomberg's John Strebek. Gains across the European equities of 1.3%, futures up in the US. That is it for the European Market Open. Surveillance Early Edition up next. This is Bloomberg.
Go.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun.
We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Here's what's coming up on today's program. Optimism spreading. European stocks open higher as traders gauge the health of China's economy. But the IMF is warning 1/3 of the world will fall into recession this year. COVID struggle. Xi Jinping warns tough challenges remain in China's battle against the virus. But signs emerge infections may have peaked in some major cities. Plus, coming up short, Tesla's quarterly deliverances miss expectations despite offering rare incentives in the U.S. and China. Well, it's been an hour of cash equity trading in Europe. Yes, European markets are higher. Equities are higher, as they are in the S&P. Yesterday, Europe ended the day with a nearly 1% gain. The U.S. fell, so maybe a little bit of catch-up. Of course, still thin trading, at least yesterday when the U.K. markets were closed, so perhaps not too much to read into that. But one of the big reversals this morning has been the yen. It started out with really strong gains, up nearly 1% versus the dollar. That was its strongest since June. It started to come back in just about 0%, basically unchanged. It was these bets that the BOJ would tighten policy further. Is that coming off, or are we just getting a difference of opinion as we get through the European Open? Gold, this one continues to be a winner this morning. It had a really tough 2022 with a stronger dollar. If that's coming back in, and we have all these warnings of a recession from IMF's Georgieva to Michael Burry, perhaps this is the year for gold. And finally, your 10-year yield, that's getting a bid as well. 11 basis points lower is where we stand. That also follows on from a European bond rally yesterday. Now, European equities, second day of gains. It's on track for its biggest two-day gain since November of last year. The real standout here is the UK, but that's simply because it has to play catch-up. We were closed yesterday for a bank holiday. It is back online, so that is one of the best performing regions, but all sectors and basically all regions in the green this morning. Of course, one fear that continues to preside over this market is China and the impulse from there. So let's get into it. Chinese President Xi Jinping has warned the fight against COVID will be tough in his first comment since Beijing's pivot away from its zero COVID policy. All of this comes after data released over the weekend showing China's economy ending the year in a slump with a slowdown in manufacturing worsening. However, there are signs of the virus peaking in some major cities, according to travel data. Joining us now is Alan Wan, Bloomberg senior editor in Shanghai. So, Alan, let's start with that speech from Xi Jinping. What were the main takeaways there?
Well, you know, the government hasn't really said a whole lot ever since it exited COVID zero about a month ago. So we're going to hone in on anything he had to say about COVID. And his message was mostly empathetic. For example, he described the policy change as a way to adapt to a virus that keeps evolving, a virus that, while it's super transmissible, fatalities are actually lower, are actually quite low. And then he also he talked about how, and it was a really more of a rare acknowledgement of the difficulties that people here in China are facing after 3 years of pandemic restrictions. And this is the most interesting part of it, I thought, was that, even though he didn't directly talk about the protests, he did say that, quote, it's only natural for people, in a country of 1.4 billion people to have differences of opinion and views. And basically, the message was a lot more empathetic than I had expected. And I was looking at last year's, same time last year's address, and it was very brief. And he talked about the rejuvenation of Chinese people, Hong Kong, Taiwan, and the Olympics coming up, but no direct mention of the challenges facing China in terms of COVID.
At the same time, in terms of those economic challenges, the Caixin PMI data over the weekend showed a major manufacturing contraction. Services were really grim as well. When do we get that rebound? When do we get the positive impulse from a populace which is igniting demand?
Yeah, that's a great question. The Caixin PMI data was pretty bad, showing that manufacturing services keep on declining. This is reaffirming what we saw over the weekend. And then we also had the China Beige Book, suggesting that the economy actually contracted in the fourth quarter, and it sees the GDP growing 2% last year. That said, that's all the bad news. But the good news is that along with that Caixin data, where they survey all these businesses, a lot of these businesses are actually a lot more optimistic about the future. There was a confidence, in terms of confidence on the 12-month outlook, it reached a 10-month high. There was a gauge of future output jumping to the highest level since February 2022, which Bloomberg Intelligence says is actually showing that how the end of COVID zero is starting to boost business sentiment. And then you got Citigroup economists saying that a PMI probably hit a low point in December, and we're going to recover from here on out. And what does this mean for the overall economy? A lot of Bloomberg economists, economists served by Bloomberg, forecast the economy growing at 4.8% this year, which is will be a lot better than the 3% which is estimated for last year.
Yeah, certainly better, but maybe just short of China's goal there. Alan, thank you very much. Alan Wong from Shanghai. Joining the program now is Michaelides, G10 fixed income analyst at Carmignac Gestion. Michael, thank you so much for joining this morning. We're just talking to Alan Wong about China, about the fact that data has been bad for December, but looking forward in terms of the demand finally coming into the picture, how are you looking at the swing factor of Chinese demand as it impacts the G10 space?
So first of all, thanks for having me. I think the earlier than expected reopening of China kind of just adds to the global demand pressures. Like, we know that in 2023, we're going to be in a situation where the world economy is slowing. As you discussed previously, we will have recession in a number of countries. And I think that is kind of already expected. The question is not whether or not we have a slowdown, but how quick that slowdown is, and whether China coming on board sooner then delays even further the point of recession in the US and makes it even less deep, the potential recession we have in Europe. So that's the way I think we're thinking of the impact of the Chinese reopening on G10 and G10 interest rates and other fixed income markets.
Well, Michael, you mentioned this idea that a recession is widely expected. There's someone else who expects it, your namesake, another Michael Burry, though. He has a tweet in terms of his 2023 view, and I want to read it to you. He says, inflation peaked, but it is not the last peak of this cycle. We are likely to see CPI lower, possibly negative in the second half of 2023, and the U.S. in recession by any definition. But this is the key here, Michael. He says the Fed will cut and the government will stimulate, and we will have another inflation spike. What do you make of that, this idea that the recession will be bad enough, the Fed blinks, and that in itself causes another bout of inflation?
I think we're several steps ahead looking at it that way around. I mean, the way that we kind of see the world is that the delay of the oncoming recession means that actually in the short term, it could look like with headline inflation coming down and the world economy getting over the initial impact of inflation, that short term things will look quite good. The Fed's strategy change will be intact. And so coming into the third quarter, things could look very fine. The problem is that underlying inflation will remain strong. So rather than us worrying about negative prints, the kind of core services that the Fed has been highlighting, that may remain quite a lot stickier. So while in the short term, the markets were probably quite pleased with the lower volatility, in the end, what we're concerned about is that you need a much harder landing to kind of purge the system from inflation, rather than the idea that we could have negative inflation prints as soon as this year.
What do you do with duration then, Michael?
So I think duration will be quite a nuanced story. I think in the US, the most likely scenario is that the market is too keen to see Fed cuts. There are probably too many Fed cuts priced in light of the new strategy of the Federal Reserve, which is not to go as quickly, not to go as high, not necessarily to go as high, but to keep interest rates much higher. So what you could end up happening is that real rates do not fall as quickly as they do in historical cycles. And for that reason, the market's playbook of recession equals aggressive Fed cuts equals you can be very long duration at an early stage in the cycle may not be the right way of thinking of it. So flatteners may be the way of thinking of it in the US, and being nimble around how quickly the inflation data comes off. By contrast, in Europe and the UK, we think the story is a bit different.
I was about to say, Michael, you were very careful to say that this is the story in the U.S. So then what is the story in Europe so far to start the year? And I know liquidity has been thin, so perhaps we can't read too much into it, but it has been a bond rally for all of Europe, more or less.
That's true. It's a one-day move. We've also had a very big sell-off in December. I think one way of thinking of the difference between duration in the US and Europe is the relative patience of the different central banks. So while both of the central banks think you will be, the ECB and the Fed, think you will be near 2% on the sort of 2 or 3 year horizon, in the case of the US, they are waiting to see the impact of the slowdown, waiting to see how quickly and the depth of the fall of inflation and what happens to the labor market. And so they may be more willing to be patient to get inflation down. I think the revisions to the data and the communication of the ECB, even after a very big sell-off after the December meeting, indicate that the ECB is not in the same position. So they want to get inflation to 2% as quickly as possible. So the speed of rate hikes and the further increase potentially in the terminal rate in Europe is potentially more likely than in the US in a structural sense. So that's why we do see differences in the duration outlook.
Yeah, just over the past few days, we heard from both Nagel and Madame Lagarde saying that they have more work to do to make sure that inflation expectations don't get entrenched. Michael, really wonderful to get your thoughts this morning. What a great way to kick off the new year. Michael Michaelides, G10 fixed income analyst at Carmignac Gestion. Now, coming up, Tesla falls in pre-market. It's down 4% at the moment after deliveries for the last quarter miss estimates. We'll have more on the electric car maker shortly. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Tesla delivered fewer vehicles than analysts expected last quarter, despite taking an unusual step of offering hefty incentives in two of its biggest markets. Joining us now to discuss is global business reporter Hee-Jin Kim. Hee-Jin, tell us more about these delivery numbers, how they disappointed what was expected.
Sure. So as you mentioned, Tesla delivered about 405,000 vehicles in the last 3 months, and that was below the analyst estimates, which was about 420,000. And the company even missed its own sales target, which was about 50% increase in deliveries last year, but it made about 40%. So this was also actually increasing concerns for the Tesla, which is the world's biggest EV brand. Everyone is checking what's going on in Tesla. There's a concern that Tesla seems to be struggling, especially in China, where there are a lot of local brands such as BYD, and we also have the fears of a recession and inflation, rising interest rates, and that's so the recent earnings from the Tesla all the adding to those kind of worries.
And already pre-market shares are down about 3.5%, just adding on to the tough year last year. So what is this latest figure? What does it mean for investors and Tesla suppliers?
Sure. So honestly, investors are actually upset about the Elon Musk's buying of the Twitter. They say, a lot of fund managers and analysts say that they still don't understand why Elon Musk is paying so much attention to the, Twitter. They say, Elon Musk should be working hard at the EV factory rather than, analyzing the Twitter's data. And also there's a concern about, from the, Tesla suppliers as well, in Asia, such as like battery makers, lithium miners. They are all, concerned about what's going on at Tesla, because, those kind of sales data from not just the EV maker, but the automobile, maker actually signals that the global economy is slowing down.
Hee-Jin, thank you very much for the update. That's Hee-Jin Kim, our global business reporter in Seoul. Coming up on the program, rail pain. UK workers are set to walk off the job for much of this week, adding to the government's troubles. Well, more on strikes next. This is Bloomberg.
COVID has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
If I had to choose one market to invest in, it would be the UK over the next year. The UK economy this year in 2022 has probably done better than almost all of its peers.
In the UK, we have got some phenomenal talent.
We have phenomenal talent here. We really do.
I regard the outlook for the UK as being better than most commentators would suggest for next year.
What this year has shown us is that the business community loves stability.
The cost of doing Brexit is now baked into everybody's thought process.
We will get through and settle inflation down. It will take some time, but all of that is within our control.
We're going to do better than the Eurozone by quite a margin, and possibly better than the US.
Some prominent investors and executives speaking to me on the UK and what opportunities and hazards they see in 2023. Now, speaking of hazards in the UK, there's more pain ahead as rail workers plan to walk off the job for much of this week. It all piles up trouble for Prime Minister Rishi Sunak's government. For more on this, let's bring in Bloomberg's Lizzie Burden. So, Lizzie, how is the government handling these strikes?
Well, it's holding its line at the moment. We heard from the Defence Secretary Ben Wallace. He says that the government isn't going to be held to ransom by the unions as it was in the 1970s. But really, no matter how much Rishi Sunak wants to do his Margaret Thatcher impression, if the strikes continue, if they broaden across the sectors, it's going to look like the end of the 1970s when the UK was paralysed by strikes, which brought Margaret Thatcher to power. Now, we're starting the year with these 5 days of rail strikes. That's holding back retailers from making the most of the January sales. It means more people are going to work from home. And that, as a theme for 2023, is something that the Chancellor, Jeremy Hunt, I understand, is very worried about because it holds back growth. But really, the overriding concern among Treasury ministers is that if they capitulate to union demands now, there'll only be more in the pipeline as inflation remains high through 2023.
So this is clearly one big concern for the government this year. What else is in Rishi Sunak's in tray?
Well, economically, it's the same macro themes as last year, the same as elsewhere, inflation and recession. The question is, can the Bank of England tame inflation without stoking the recession it says the UK is already in? And in his New Year's message, Rishi Sunak said that, yes, 2022 was difficult, 2023 is also going to be difficult. And I find the executives you interviewed extremely optimistic there, in contrast to a survey of economists that was in the FT, 101 of them who said that the UK's recession is going to be longer and worse than any other G7 country. The words they were using were bleak, miserable, grim, so very different indeed. And that's going to shape the Tories' agenda for 2023 because they're very behind in the polls. One poll said that they were 26 points behind Labour. They've got to call an election by January 2025. 2025. And so in the meantime, they're going to have to show that they have the talent, the ideas, the unity to get another term in the bag. And so 2 key dates will be the March 15th budget. They need to show that they're serious about growth, that the dullness dividend has paid off and they're now willing to take some risks and grow the economy, the one thing that everyone agrees Liz Truss got right. And then the other date is in April, the 25th anniversary of the Good Friday Agreement. Can they get a compromise on Brexit to deliver that stability that Poppy Gustafsson from Dark Trace told you she says businesses desperately crave?
So just an easy, breezy year ahead. Nothing big on the agenda.
It's Rishi Sunak. Let's give him a chance.
Lizzie, thank you so much. As always, Bloomberg's Lizzie Bird in there. Now, we're going to be covering all things all UK every week on Thursday. It'll be at 9 a.m. UK time in our half-hour special, so be sure to tune into that in the next few days. Now let's get to our Bloomberg First Word News. With that is Laura Wright. Good morning, Laura.
Good morning, Danny. President Xi Jinping has spoken out about China's COVID pivot, saying tough challenges remain in the fight against the virus. In a New Year's address over the weekend, Xi said the country is in a new phase of COVID control and has adapted after following a science-based and targeted approach. IMF Managing Director Kristalina Georgieva says a third of the global economy will face recession this year. In an interview with CBS, Georgieva said 2023 will be a tougher year than the one we leave behind. She says the US, the EU and China are simultaneously slowing down, with the outlook for emerging markets even worse. Moscow's defense ministry says a Ukrainian strike on a Russian military facility in the occupied east has killed 63 troops stationed there. Ukraine, meanwhile, has warned that Russia may launch more attacks over the Orthodox Christmas holiday later this week. China's economy ended the year in a major slump as business and consumer spending plunged in December as COVID infections spiked. Official data showed the decline in manufacturing worsened last month, while activity in the services sector plunged the most since February 2020. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Danny.
Laura, thanks so much. Laura right here in London. Now, equities continue their climb in Europe. It's a second day of gains. U.S. futures also pushing highs for the morning. They're up 1.1%. Now, the yen is coming back a bit. It was unchanged. It did start this morning up 1%. It goes to unchanged. Now it's higher. We're stronger versus the dollar by about 1/3. It is traders betting that the BOJ is indeed going to have to tighten. Also, those recession concerns driving investors to havens, not just gold, but treasuries as well. Coming up, Turkish inflation decelerates at its steepest pace in more than a quarter of a century. We'll have more on that next. This is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Optimism spreading. European stocks open higher as traders gauge the health of China's economy. But the IMF is warning 1/3 of the world will fall into recession this year. COVID struggle. Xi Jinping warns that tough challenges remain in China's battle against the virus. But signs emerge infections may have peaked in some major cities. Plus, missing the mark. Tesla falls pre-market after quarterly deliveries miss expectations. That's despite offering rare incentives in the U.S. and China. Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's talk about Turkey. And inflation there decelerated at its steepest pace in more than a quarter century. Consumer prices rose at an annual 64.3% in December. That's down from 84.4% in the previous month. That all according to data released by the government today. Joining me now is Bloomberg's Turkey Bureau Chief Onur Ant. So, Onur, how much of this inflation slowing is simply just base effects from what we saw last year?
Pretty much all of it. Turkish inflation in December 2021 was massive because of a sudden depreciation of the currency of lira, which made imports a lot more expensive and fed into prices. So that steep fall that we saw in inflation rate this morning from December is largely, if not all, a reflection of high base of prices from a year earlier.
Given that, does this change anything for monetary policy, which has been unorthodox to say the least?
Probably the implications for monetary policy will be very subdued. As you said, Turkish interest rates are already quite low compared to the current level of inflation or the expected path of consumer price increases. Where we expect to see the change, the real change, is going to be the fiscal side. Between now and the general elections scheduled to take place in June, we expect to see a big ramp up in spending by the government to keep growth strong while trying to keep consumer prices under control to the extent it's possible.
So what does that then mean, Onur, for the near-term inflation outlook in Turkey?
Near-term inflation outlook is quite different depending on who you ask for their outlook. The government expects to see the inflation rate at around 22% by the end of this year. That's quite low compared to the median forecast in survey of analysts who expect to see the inflation rate at around 44% at the end of this year. Now, we expect the sudden steep fall in inflation rate to kind of stall, and we expect the price increases to sort of follow a more gradual path going forward, thanks to the expected spending by the government that I just mentioned. We expect the fiscal side to basically keep prices at elevated levels going forward.
Okay, Onur, thank you very much. That's Bloomberg's Turkey Bureau Chief, Onur Ant. Now, Bank of Israel Governor Amir Yaron says inflation is likely to start falling after February and sees an economic slowdown, but not a recession in Israel. He spoke to Bloomberg's Yusuf Gamal Eldin.
We are determined to bring inflation down back into its target, which in Israel it's 1 to 3%. We're currently at an inflation of 5.3%. We have done a very decisive front-loading, and as you said, we are at 3.75. We believe we will still see inflation on an annual basis going up in the next 2 months, but then afterwards, modestly declining, and then even more so declining back in the second half of 2023 into the target rate. We understand it's painful for many of the citizens who've taken mortgages, but this is a step that must be done in order to prevent further pain down the future.
Where do you see green shoots for inflation moderation when you look at the data sub-headline? Where would you argue things are beginning to show a real improvement?
Well, we are seeing still strong, we're seeing inflation in many and wide array elements or sub-elements of the CPI. We are seeing it in the non-tradables, and this is why we still have taken a 50 basis point hike. On the other hand, if we're looking at the 6 months inflation, we are seeing some elements of moderation, and this is why we believe that after February, towards the end of the first quarter, we will see inflation in Israel starting to progressively go down. But this obviously will be affected by many factors, such as exogenous factors, what is happening around the world in terms of slowdown and in terms of supply chains farther coming down, and in terms of internal things in Israel, what kind of a budget will be put in place, how large of a fiscal expansion there will be.
The IMF came out with a dire warning on the global economy for 2023, specifically those that are likely to face a recession. I'm wondering whether the team at the Bank of Israel has been able to quantify the probability of a recession in Israel.
Yusuf, this is a very good question. Israel is not an isolated island. We are an open economy that's highly dependent on the global economy and the major blocs. We have lowered our, the GDP forecast for 2023 from 3.5 to 2.8. I want to remind you that Israel has had 2 successive years of very high growth. We are expecting 6.3 in 2022, and it was 8.3 in 21. So stepping down to 2.8 is a major slowdown. Having said that, in international and global perspective, this is still a pretty high growth, and it clearly is affected by us internalizing the fact that there is a slowdown in the U.S. There is probably a more immense or maybe even a recession in Europe, which are highly affecting us. But still, 2.8% is a slowdown, but it's not a recession in Israel. And we're expecting in 2024 to go back to 3.5%, which is not very far from our potential growth.
Governor, I was talking to my team, and we looked at some data that showed that the Israeli shekel had its worst year since 1998 against the U.S. dollar. A year before that, of course, there was quite a bit of outperformance for the Israeli shekel. How do you find this middle ground, and where does it feature in your calculus for the remainder of this year, given your fight against inflation?
First of all, the shekel has been very volatile throughout the year. Even just in the last quarter, it's visited somewhere around 3.38. Now it's just around 3.5. The shekel in relatively high frequency is very much tied to what is happening in the S&P 500, partly because of the large sums of money that our institutional investors are invested abroad. On the other hand, there are other fundamental factors, such as the surplus in the current account, the FDIs that are invested in Israel, and the high tech. And we will have to see how that balances out. Of course, a depreciating shekel puts some pressure on inflation. And if we see it really deviating to the point where it is really, really stressing out of bounds the pressure on our forecast for inflations, we have the tools to also deal with that within our arsenal.
That was Bank of Israel Governor Amir Yaron. I want to give you a quick look at what the natural gas complex is doing at this moment, because we see continued declines, especially in European natural gas. Well, both U.S., which is the top one there, and European. European futures, those are falling by some 4%. That's Dutch front-month futures. That's now at its lowest level since February of last year. So, in other words, it's the lowest since pre-invasion of Ukraine. The same forces are happening in the U.S. Nat gas in New York is also at its lowest since February of last year. This is because of unusually mild temperatures. In Europe, we're expecting temperatures to be higher than the average for the next 2 weeks. In the U.S., it's higher through mid-January as well. All of that allowing some relief, and is possibly some of the reason we're looking at bonds rallying as well this morning. Germany 10-year yields, for example, those are off by about 7 basis points. They also rallied yesterday as well. Bonds pushing higher in the U.S. 10-year yield lower by 13 basis points. Perhaps if the energy complex isn't as bad, inflation won't be as bad as well. That follows on, of course, that the Federal Reserve won't have to be as aggressive hiking rates. Same with the ECB, though, of course, we heard from Nagel over the weekend, yesterday, and Christine Lagarde saying that they are concerned inflation expectations will become entrenched, and therefore they need to continue hiking rates. But at the moment, nat gas, both in Europe and the U.S., falling further to February 2022 levels. Coming up, the yen advances to a 6-month high versus the dollar, with Japan's decision to raise its bond yield cap stoking bets that the nation may tighten policy even further. That's next. This is Bloomberg.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
It's the first jobs report of the new year.
The labor market has not cracked.
A lot of that's a function of labor shortages.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Can you walk us through how the Federal Reserve conversation has reset?
We're still seeing a strong economy, so the Fed has to do more.
Why are people so confident that there is going to be some massive deceleration?
I just don't see the evidence.
This could go a lot of different ways.
The December Jobs Report, Friday on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. The yen has advanced to a 6-month high versus the dollar as Japan's decision to raise its bond yield cap last month has started to stoke bets that the nation may tighten policy even more. Let's bring in Bloomberg's chief North Asia correspondent, Enda Curran, for more on this. So, Enda, this, of course, the gains in the yen comes off the back of the BOJ spending the most to defend the 10-year yield on record. So what do we make of a yen that continues to gain despite the BOJ doing and saying something different?
Well, it's a big reversal. Remember last year, the yen was being written off as a safe haven currency, kind of a pivotal turning point for Japan's economy. But like you mentioned, there are a few things going on now. First of all, of course, there's been support for the currency from the government and the central bank. There is a lot of illiquidity in the foreign exchange market at the moment, with Japan being out. That means it's kind of gapping higher a little bit. Dollar strength coming off the ball is also helping. But as you say, a lot of it comes down to the Bank of Japan and this idea that maybe they are now shifting just before Christmas. Remember, they made that decision to lift the cap in their bond yields a little bit. That stoked some expectation that they are now moving away from those very dovish policies because of where inflation is at in Japan. Others, of course, argued it was merely a move to try and offset the illiquidity in the bond market, given the massive BOJ intervention there. Regardless, the end result, along with these other factors I mentioned, has been that the yen is where it's at now. It's rallying. A lot of investors say it should never have been written off anyway, and this stronger yen will probably be welcomed by the Bank of Japan in terms of its impact in keeping a lid on imported inflation.
And you mentioned some of the difference of opinions. Is there any strong consensus as to whether we see a change of BOJ policy this year?
Difficult to say because we'll have a new governor in the months ahead, Danny. Governor Kuroda will be stepping down. There will be somebody appointed to replace him. There's some discussion around what kind of an agreement might come out of that between the Bank of Japan and the Finance Ministry. Will there be a material change to the Bank of Japan's mandate? These are all the talking points at the moment. There was a view that maybe Governor Kuroda was kind of getting the house in order for the incoming governor by making that move on the yield curve control that I mentioned that he did just before Christmas, and perhaps now we're in for maybe a quieter few months. But regardless, with Japan, there is a lot of focus on the very dovish policy that Governor Kuroda has doubled down on. Even though inflation is proving to be stickier than expected, he continues to say it's mostly tradable. A lot of it is down to the price of oil that Japan imports, for example. Others are saying that BOJ really needs to move away from this massive support that it continues to pour into the economy and tighten policy a little bit. So these are all talking points in the months ahead, but the big change for the Bank of Japan is expected to come when the new governor takes over, and of course he or she will then signal what way he or she wants to take policy in the months ahead.
And when it comes to this global economy, we continue to hear warnings, it feels like every single day, that there will be a recession. As to whether it's mild or not, that's a different question. But the IMF's Georgieva is the latest to contribute to that, saying that a third of the world would be in a recession. How in line with that is it with investor expectations, with economist expectations more broadly?
I think broadly it's in line, Danny, because we know what's going on in the three big blocks. The China COVID-0 story is kind of well understood in terms of the impact it's having on consumers and on businesses there. Europe, of course, is getting the spillover from the Russia war in Ukraine. The US story is all about Fed raising rates, and the economy slowing down as well. But, you know, as you say, there are those making a contrarian argument now. There's a viewpoint that once China navigates the public health aspect of its exit from COVID-0, you might start to see consumers rebound, manufacturers get going, and the economy gets on its feet again. You know much better than I that in Europe there's talk there of the milder winter and the impact that's having on gas prices. And of course in the US there's a view that the labour market remains strong. We'll get job payrolls on Friday, and as long as that remains strong, perhaps the US might pull off a soft landing. So yes, a lot of concern for where the world economy is headed, given everything, the conditions that we saw through much of last year. But as I say to you, there is this counter argument that perhaps there might be some upside surprises in the months ahead.
Yeah, natural gas in Europe at the moment, it's lowest since February of last year. Enda, thank you very much. Bloomberg's Enda Curran there. Let's get your Bloomberg Business Flash now. With that is Laura Wright. Good morning, Laura.
Thanks, Danny. Tesla deliveries fell short of estimates in the latest quarter, despite offering large discounts in the US and China. The electric car maker handed over just over 405,000 vehicles to customers, below consensus Bloomberg forecasts for around 420,000. While the total was a record for Tesla, the firm came up short of its goal to grow deliveries by 50% last year. UK rail workers will walk out for much of this week, disrupting the usual return to work after the holidays. Unionised railway staff will strike for 5 days from Wednesday, with nurses and ambulance drivers, among others, also due to take industrial action later in the month. The protests stem from growing anger over the tightest cost of living squeeze in decades. China Evergrande Group has vowed to repay debt in 2023 after again delaying announcements of a much-anticipated restructuring plan. In a New Year letter to staff, the property developer's chairman says it's a crucial year for Evergrande to deliver residential projects it pre-sold. He added that construction resumed last year for all of its more than 700 real estate sites. SpaceX is reportedly raising $750 million in a funding round that values the company at $137 billion. CNBC says Anderson Horowitz will be the lead investor, having previously backed the space transport company run by Musk. Last month, sources told Bloomberg SpaceX was offering insider shares at $77 apiece, valuing the company at about $140 billion. That's the Bloomberg Business Flash. Danny.
Laura, thank you so much. Coming up on the program, after the biggest loss for 60/40 portfolios since the global financial crisis, better days may lay ahead for the trillion-dollar complex of balanced investment strategies. We'll discuss that next. This is Bloomberg.
When I started, I had no idea it was going to turn into this. This is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. After the biggest loss for 60/40 portfolios since the global financial crisis, better days may lay ahead for the trillion-dollar complex of balanced investment strategies. amid an optimism that inflation has peaked. More than 60% of respondents to the latest MLive poll survey are betting that stocks and bonds will move in opposite directions this year. Joining me now is Heather Burke from our Bloomberg MLive team. So Heather, it's not just 60-40 that did poorly. The element of stocks in there, its worst year since 2008. You have a cracking piece out, your outlook for the S&P 500 for this year. What are you expecting?
We're expecting some small gains. The MLive Pulse Survey forecasted the S&P to end about 2023 about 4,000. That would be about a 4% gain from, yes, indeed, a horrible year for stocks. We expect, a tough first half of the year. We expect earnings to keep falling. The macro backdrop is still tough. That being said, we see improvement in the second half of the year. Consumer confidence stays still strong. The job market's still fairly robust. And we'll see those earnings start to turn positive again year over year by the fourth quarter, which should underpin, the small gains that we're expecting.
Okay, so that's the stock side of things. When it comes to bonds, in the survey you took of MLive readers, what was the overall view? I mean, does it come back, for example, as a hedge against stocks when they were correlated for the past 2 years?
Yeah, I think bonds will come back as a hedge. Our survey found that the 10-year Treasury yield could end next year at 3.5%. There was a high of 4.24% in 2022. So we do see, and again, the big finding is that we see the stocks and bonds moving in opposite directions, and that should help balance portfolios. Back in 2022, we saw in a lot of cases both falling, breaking that traditional relationship on inflation fears. We're hopefully going to see some inflation starting to ebb. We're starting to see that in Europe. We've seen that with the US CPI. Obviously, it's still far from the 2% that central banks like the ECB would like to see.
Right. So how important then to that view is what the Fed does from here on out?
I mean, our survey expect the Fed funds to peak about 5% to 5.25%, which is kind of what we've seen sort of in other forecasts. That being said, people are seeing a Fed rate cuts in 2024, which, the Fed is saying we're a long way from seeing those, especially with inflation still running so hot.
Okay, Heather, thank you very much. That's Bloomberg MLive's Heather Burke with the latest MLive poll survey. MLive goes where you want to head on your terminal to get analysis from Heather and the rest of the team. Energy prices, natural gas, they continue to fall in both Europe and the U.S. Dutch front-month futures and New York-listed nat gas, those both at the lowest since February 2022. So that is pre-invasion levels. That's because the weather, it is mild. That potentially may help us avoid the worst of a recession. Of course, I was talking to Fiona Bull from S&P Global earlier, who said it is not this winter you need to worry about, it is next winter. Even so, that is allowing risk on to reign supreme when it comes to the cash equity trade for Europe. Those shares, Europe Stock 600, up nearly 2%. It is the second day of gains for the European index. It will be its best two-day gain since November of last year. You're also looking at a 10-year yield that is coming in. Maybe there still is some haven buying happening here. Those yields lower by about 13.5 basis points, but that could also just be energy coming back in. Less inflation, less rate hikes needed. 3.7389 is where you stand on your 10-year yield. Bloomberg with Surveillance Early Edition continues in the next hour with Matt Miller, Kaylee Lyons in New York, and Anna Edwards here in London. This is Bloomberg.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I
think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long and a persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
This is going to be a tough year, tougher than the year we leave behind.
The Chinese economy is doing quite poorly. Zero COVID is a major contributor.
It has not been an easy journey for anyone. We have now entered a new phase of COVID response where tough challenges remain.
This is Bloomberg Surveillance, early edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. China's economy ends the year in a slump as the COVID outbreak is blamed for a plunge in business and consumer spending. But have cases peaked in some urban areas? Tesla's year-end discounts aren't enough. Elon Musk's electric car maker sets a record for quarterly deliveries, but the total still misses estimates. And maybe the global natural gas crisis won't be that bad. A warmer-than-expected start to winter is easing fears of shortages and skyrocketing bills. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, there seems to be a long list of things for investors to worry about in 2023, but investors didn't get the memo this morning, certainly buying risk on both sides of the Atlantic.
Yeah, definitely a strong start to the year for equity markets really around the world, something that began in Asia overnight where most stocks were higher. Japan was closed for a holiday, but we actually saw gains in Hong Kong and China after being down at the beginning of the session. So as a result, the MSCI Asia Pacific Index as a whole up about 0.5%, and the Chinese CSI 300 ended the day higher by about 0.4%. Interesting, though, to see Chinese assets catching a bid after the data we got over the weekend. PMIs for December showing a deepening contraction in the Chinese economy. You saw a deeper slump in manufacturing. The services gauge actually slumped the most since February of 2020, which really goes to show you the effect of the unleashing of the Chinese people, the abandonment of COVID zero policy, and the surge in COVID cases seen as a result. But maybe some optimism is around the fact that when you look at mobility data in certain cities, it shows that we are seeing a rebound, maybe signaling a peak in cases. So that may be what risk appetite those who want to buy risk are clinging on to, and that is definitely true for the offshore yuan as well, which is strengthening against the dollar this morning to 6.91. Also strengthening against the US dollar, though, off of the strongest point of the session is the Japanese yen. Currently, dollar yen trading at 130.48. We actually were below that at the strongest level in 6 months earlier on in the session, Matt. Really interesting to see the FX market pushing back against the BOJ, clearly betting that they are going to have to make more tweaks, perhaps, to yield curve control.
Yeah, I think very fascinating. The BOJ, listen, it was one of the most interesting stories of 2022 and will continue in 2023. But also fascinating to me is that you've got the yuan and the yen down against the dollar, the greenback up against pretty much everything else. Here you can see on the third row the Bloomberg US Dollar Index, or for those of you listening on radio, I will walk you through it. Right now we're at 12.55. That's up 0.7%. So the dollar really strong, which is counter to what we see in the Asian, at least the Asian major currencies, and also in terms of S&P futures, we're looking at a big gain right now, 1.1%. And typically when you see a big gain in the US dollar against other major trading partners, that puts a damper on risk appetite. You typically see then futures down at this time or the cash trade falling, and right now we just don't see that. The US 10-year yield coming down, 370, 370 is the level there. So investors are buying bonds as well as stocks. It's interesting because in an MLive Pulse survey that we're going to talk about, investors expect 2023 to reverse that. So to go back to the time-honored inverted relationship of stocks and debt, so that they sell debt when they buy stocks or vice versa. I also want to point out gold here, up 0.7%, 1838 a troy ounce is the level. And I'm going to start putting gold or other commodities here, Anna, instead of Bitcoin, because it just hasn't moved since the collapse of FTX. Without looking, I'm going to say we're at 16,700 and change. And that's going to be the case, or has been the case at least for the last 5 or 6 weeks.
Yeah, absolutely. I think it was 16,700 and change last time I looked, Matt. I'm sure we'll put it back in there if it starts to move. What is moving today, though, Matt, is European stocks in conjunction with US futures. We are seeing some real strength coming through in Europe today. We have the London market playing catch up, but even in the continental European markets, which gained by 1.7% in yesterday's session, we're still seeing more room for positivity. And in fact, some of these markets up by nearly 1.5%, the German and the French market in amongst them. Let's have a look at some of the assets I pulled out to talk about today. And in there, the FTSE 100, it is playing catch up, as I mentioned, because it was closed yesterday, but up by more than 2% now. And in fact, if you look at this index, only one stock on the FTSE 100 is in negative territory. That's how broad-based the positivity is for global stocks today. And for FTSE 100, it is actually a gauge of global stocks and not necessarily the UK. Here's the travel and leisure sector. This is one sector that's doing really well. So this is airlines, it's aviation, it's gaming companies as well, but it is very much the aviation side of things that is pushing this sector higher today, up by more than 3%. A note out from Citi talking about how they like long haul over short haul, but that doesn't stop both of those parts of the aviation space from rallying today. The euro is weaker, down by just over 1%. Really, this is the strong dollar, though, that Matt was talking about, the strong dollar story. 105.53 is where we trade, but there is some data out of Europe that's of note. We'll get the inflation print for the Eurozone a little bit later on this week. We'll get Germany's inflation print later on today, but we've had 5, 6 regions of Germany already reporting, and most of those showing that the inflation rate year on year has dropped by more than 1 percentage point compared to the previous month. So moving in the right direction in terms of getting a handle on inflation. And here's one of the reasons why the natural gas price continues to fall, down by another 4.6% after the drop yesterday. And it does seem as if the weather forecasts from here then, Matt, are for more mild weather, at least in the week or two ahead for continental Europe. And that could be, again, good news for the economy and indeed for gas prices.
Yeah, definitely prices that caught my eye over the holiday weekend. Let's kick off, though, with what we saw in terms of China. Economically, the year ended in a major slump. Business and consumer spending plunged in December, with more disruption likely in the coming months as COVID infections surge. China's President Xi Jinping recognized the challenges ahead in a New Year's address.
With extraordinary efforts, China has prevailed over unprecedented difficulties and challenges, and it has not been an easy journey for anyone. We have now entered a new phase of COVID response where tough challenges remain.
Enda Curran, Bloomberg's chief Asia economics correspondent, joins us now from Hong Kong. And Enda, the reopening seems to, have question marks on it still, because the economic slump that we all saw at the end of China is, in some ways, belied by a jump in high-frequency data.
Yeah, so two ways of looking at it. On the one hand, Matt, the economic hit has been deeper than expected. We had PMIs out over recent days, both official and private sector, showing that the manufacturing sector remains in the doldrums, and the services side of things took its biggest hit since February 2020. So December was a bad month for the economy as China transitioned the exit from COVID zero. However, to your point, we are now getting some more high-frequency readings on subway usage, for example, in key cities. That's showing a pickup in the number of passengers taking those subways. That, of course, lends itself to consumer confidence, and maybe people are getting out and about again, and some suggestions that perhaps the disease is peaking in certain parts of the country. Likewise, industrial production in, for example, the famous iPhone city in China, back up towards 90%. But that said, we're obviously still very early in this exit from COVID zero for China. The public health story remains number one. The economic story is expected to stay very choppy, and we won't get much clarity on the economic recovery until perhaps sometime in the second quarter.
Well, and as Matt and I both mentioned, with that as the backdrop, you are seeing the offshore yuan gaining against the dollar, and the other big Asian currency also gaining is the yen, which hit its strongest since June earlier on in the session. Some pretty significant pushback, I would say, to the Bank of Japan. What are the odds that Kuroda actually gives in?
Well, it's a big turnaround for Japan. Last year, the story was the yen was being written off as a safe haven. Here we are now back at its high since June. There's a big rally underway. Some investors saying that there's plenty more upside to go. It does reflect, of course, illiquidity in the market given the holiday time of year. It also speaks to the idea, though, that perhaps the Bank of Japan may be moving away from some of its most dovish policies. We know what they did before Christmas in terms of lifting the cap on their bond yield program. Some say that they will do more in the coming months to move away, given where inflation is where it's at. The Bank of Japan, of course, continues to double down on its dovish message. They don't believe inflation is going to be very sticky, and they say the economy needs more support. But there's no doubt that as we start the year, the yen is certainly in a very different position than where it was as recently as September, when many big investors were betting against it.
Okay, yeah, times have changed, haven't they? Certainly at the end of last year. Enda, thank you very much. Bloomberg's Enda Curran with the latest on the Chinese growth story and indeed the Japanese currency moves. Let's go from Asia stories into the United States. And Tesla delivered fewer vehicles than analysts expected last quarter. Joining us now with analysis is Bloomberg's Craig Trudell. Craig, good morning to you. Good to see you. So this was a record quarter of deliveries for Tesla and a first month over 400,000. But what? That's not good enough, it seems.
Yeah, and it's not just the case of not meeting Wall Street's expectations. It's actually the expectations that Tesla set as well. You know, they talked during the last earnings call about being just under the 50% growth rate that they've said they expect to average over several years. They came in at 40%, so not particularly close to that number, and also, you know, falling short despite the fact that they did something very unusual at the end of last quarter, which was, you know, offer pretty substantial incentives both in the U.S. and China. So this is a case of you know, demand concerns that the company, you know, was having trouble sort of, you know, batting away. Only being sort of reinforced by the performance at the end of the year.
So we've also seen Elon Musk tweet a couple of times in this fresh new year about a setback related to U.S. tax credits. What's he talking about?
Yeah, so this has to do with the Inflation Reduction Act. There was obviously a lot of expectation of, you know, just how many electric vehicles would be eligible for tax credits under that law. Obviously, Tesla and General Motors were, you know, potentially going to be big beneficiaries because they had hit a cap that, you know, basically led to their incentives running out. The problem is the way that the IRS is sort of, you know, limiting ability for some of Tesla's models to be eligible because of, you know, some minutia with regards to how they treat the Model Y. Some versions of the Model Y they categorize as a sedan and others as an SUV, depending on whether or not it's a 5 or 7 seat version. And so there's some concern as to whether any Tesla models will be eligible for the IRA unless the company cuts some prices. So, you know, that obviously is something that was, you know, hoped would boost demand in the first quarter. And there's now some real doubts as to whether or not that will be as much of a tailwind as hoped.
All right, Bloomberg's Craig Trudell, thank you so much. Now, let's turn to the commodity space. A warmer than expected start to winter across large parts of the world is rapidly easing fears of a natural gas crisis. Rachel Morrison, Bloomberg's editor for Power, Gas, and Renewables, joins us now. So, Rachel, are fears of a cold snap over? Can we expect prices to continue to cool for the winter?
Well, what we've seen is a really mild start to this year, and demand has fallen as a result of that. And we expect that usually over the holiday period, but even at the beginning of this week, we've seen prices continue to fall, and the weather forecast does look mild for this week and sort of into next week. Ahead of that, it's less certain what will happen. But what that allows us to do in Europe is to rebuild gas storage supplies. So instead of withdrawing from storage, while the weather's been like this, we've been able to put gas back in. So even if it is cold, even if we do get another cold snap, because we can't rule that out, we always use the example of the beast from the east, which came in March, when you sort of think the worst of winter is usually over. So even if that happens, the more gas we have in storage, the less of an impact it will have on prices. What will be interesting to see is last year the price trend reversed, where we had much higher prices during the summer when we're usually refilling gas storage. So depending on how much we use and what levels are like at the end of the winter, we'll see what the summer will be like. But just because it's mild weather now doesn't necessarily rule out higher prices later on. But for the moment, it does look better than people feared.
Okay, and Europe has been, of course, Rachel, the epicenter of concerns around gas supplies, given the supply issues with Russia. Are European fears of a Russia-induced supply crunch fading then? I mean, so little is received from Russia, if anything, now, and so alternative plans have been made for this winter at least. I mean, structurally, bigger changes needed for winters ahead.
Yes, that has been quite successful in that Europe has been able to secure alternative supplies. And as we go further on, there becomes less that Putin can do. However, there are still some gas that transits Ukraine to Europe. And there are still worries that shelling and as the war goes on there, that infrastructure could be damaged and that could halt those flows. Although we sort of think that could provide a bit of a short-term shock to prices, but then ultimately Europe should be able to continue to get supplies of LNG, mainly what we've replaced pipeline Russian gas with. However, where the cold weather does have an impact globally is if there's colder weather in Asia, in the US, and it makes it more difficult or more expensive for Europe to get supplies of LNG, then obviously our prices will rise too. So perhaps there is less of an impact from action that Putin can take. However, there's still very much a global story to what will happen to gas prices.
All right, Bloomberg's Rachel Morrison, thank you so much. Now let's get back to the U.S. equity market and take a look at some stocks moving in pre-market trading. We were talking about the China story with Enda a moment ago, and really optimism around the idea that COVID cases may be peaking, at least in some areas, is lending a hand to stocks sensitive to that story, including Wynn Resorts, which is a big casino operator, heavy revenue exposure to Macau. It is up about 3%, and you're seeing some of those Chinese technology companies, those ADRs gaining as well, including Alibaba and JD.com, which are each higher by the better part of 3% too. Now, it's not just Chinese tech that is gaining in pre-market trading, but mega-cap U.S. technology is as well. After what was a brutal 2022, you are seeing the new year starting off a little bit better for some of these names. Alphabet is up 1.6%, Amazon by 1.7%, and NVIDIA up by 2%. And of course, both Amazon and NVIDIA were down by 50% last year, Anna. So we'll see how this first trading session really sets the tone for these names in the year ahead.
Yeah, it's interesting to see how the European sectors that are gaining the most today are some of those that were beaten up last year. Travel and leisure, technology, as you mentioned, Kaylee, also real estate. Coming up on the program, we will talk about 2023 and the investment outlook. Hans Olsen joins us, Fiduciary Trust CIO. We'll get his perspective on the year ahead. And on their top risks for the year, we'll be speaking with Eurasia Group's Chairman Cliff Kupchan. We'll talk about the year ahead. We'll also look back at the risks they identified last year and see how well they did with those. Plus, Wall Street's year ahead. Today's Big Take story gathers more than 500 strategists' calls to help paint the upcoming investing landscape. Look for that online or on Bloomberg or on the Bloomberg terminal. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kayla Lyons here in New York and Anna Edwards out in London. Happy New Year, everybody. Now, Michael Burry, made famous by Michael Lewis in his book, The Big Short, and played by Christian Bale, of course, in the movie, put out a fun-filled tweet that I think we need to dissect a little bit. I've got it up here on the screen. He says, yeah, inflation peaked, but it's not the last peak of this cycle. He says we will go lower and maybe even negative in the second half, and the U.S. will be in a recession by any definition. He doesn't give a date there, but sometime in the future, the U.S. will be in a recession. I guess it's implied that it's the second half. The Fed is going to have to cut, and the government's going to have to stimulate with some fiscal, I guess, helicopter drops. Let's get to Justina Lee right now, joining us to talk about this and markets in general. Justina, it's really interesting that Michael Burry comes out and says the Fed's going to have to cut because we're going to go into such a deep recession in 2023. Does that jive with consensus?
Yeah, that's a really big call there. But I think one part of the tweet that's really hitting at some of the big themes this year is the call for a recession. Now, if you look at all those Wall Street outlooks that they put out, I mean, that word does come up a lot. And it's one reason why a lot of strategists are expecting at least a better year for bonds, if not stocks. But I think the more controversial part of that tweet is the call for a rate cut. And now that is currently priced in the derivatives market, but we have seen Fed officials trying to push against that narrative. I mean, talking a lot about how they will need to see a persistent slowdown in inflation before they even, think about stopping their monetary tightening campaign.
Justina, good morning to you and Happy New Year. You mentioned that because of these expectations around a recession, many strategists are talking about what bond markets might manage to achieve. And I know the Markets Live team had a survey out that surveyed hundreds of investors and got their thoughts. And they did indeed suggest that bonds would stage a comeback as a hedge against stock losses. So what's sort of ahead for the 60-40 portfolio then in that context?
Well, that will at least be very good news because one big problem in 2022 was that bonds and stocks fell together. So that correlation turned positive. But if we at least get a rebound in bonds, I mean, you have that buffer back in your portfolio, even if it's a worse year for stocks. And that's certainly something that a lot of strategists have been talking about.
Okay, Justina, thank you very much. Bloomberg's Justina Lee with the latest on the markets. And for more market analysis, check out MLIV Go. That's the function to use on your Bloomberg terminal to find the Markets Live blog. This is Bloomberg.
What's happening on Wall Street?
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
When I started, I had no idea it was going to turn into this. This is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
Now, keeping you up to date with news from around the world, here's the first word. Ukraine struck a Russian military facility in an occupied town, killing at least 63 troops. It's one of the deadliest losses acknowledged by Moscow. Russia says the facility was hit by 4 U.S.-made rockets. More troubles for UK Prime Minister Rishi Sunak. British rail workers will walk off the job for much of the week. They'll strike for 5 days starting Wednesday. Nurses and ambulance drivers plan to strike later on in the month. Unions are demanding bigger pay hikes to deal with record inflation. And in the National Football League, Buffalo Bills player Damar Hamlin suffered a cardiac arrest and collapsed on the field during a game with the Cincinnati Bengals last night. Hamlin, who is just 24 years old, is in critical condition in a Cincinnati hospital. Stunned teammates surrounded him while he was being treated by doctors and paramedics on the field. The game was postponed. Coming up, we will turn back to the markets and get the 2023 investment outlook from Hans Olsen, Fiduciary Trust CIO. Does he agree with our Bloomberg MLive survey that shows somewhat of a comeback for the 60-40 portfolio once again this year, and bonds and stocks acting as a hedge against each other? That's next. This is Bloomberg.
Fascinating entrepreneurs because you all started really young. What did you learn? Did you always think that you'd be an entrepreneur? Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5?
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, of the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close.
Welcome to Bloomberg Crypto.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. China's economy ends the year in a slump as the COVID outbreak is blamed for a plunge in business and consumer spending, but have cases peaked in some urban areas. Tesla's year-end discounts aren't enough. Elon Musk's electric car maker sets a record for quarterly deliveries, but the total still misses estimates. And maybe the global natural gas crisis won't be that bad after all. A warmer-than-expected start to winter is easing fears of shortages and skyrocketing bills. I'm Anna Edwards in London with Matt Miller and Katie Lyons in New York. And Matt, European stocks, US futures, all suggesting a buoyant risk appetite, I suppose, as we start 2023 at least.
Yeah, I guess that's got to be the market headline, right? US stocks, European stocks set to kick off 2023 with a rally. And we do see futures higher this morning. Right now, about 0.9% on S&P futures at 38.95. Now, it's interesting because you have investors buying futures at the same time that they're buying bonds. That pushes the yield down, and buying the dollar right now up about 0.8%. And we have been expecting, or at least an MLive Pulse survey expects that the stock and bond picture will diverge in 2023, which is the way it's supposed to be, according to Economics 101. As stocks rise, investors buy stocks. They take that money from bond holdings or sell bonds to fund that trade. Also, you typically see people buying bonds as a safe haven, and that means they're scared of stocks. So it's interesting to see them still moving in the same direction today. We have seen the Bloomberg Dollar Index. Last year, the incredible strength in the dollar really also worked against risk assets. So when you saw a strong dollar, that meant you saw a sell-off in stocks. We don't see that happening on the first trading day of the year. I also want to point out that gold continues to gain strength at 1836. It really hadn't acted as the inflation hedge it was supposed to be throughout the runaway inflation we saw in 2022, and it'll be interesting to see how gold holds up as the Fed continues to raise rates into this year. Kaylee, what do you see in terms of pre-market movers?
Well, that move in yields is really noteworthy, Matt. 13 basis points down on the day, and that is giving a hand to some of those high multiple mega cap technology stocks. The one is sitting out that rally, and that would be Tesla. The stock is down about 3.7% right now after we got fourth quarter deliveries data over the long weekend. And even though it was a record quarter, above 400,000 cars delivered, it missed Tesla's own expectations and the expectations of the street. And that was despite really heavy discounting that Tesla did in many of its major markets. So once again, fueling concerns about demand for those electric vehicles. The stock adding to the declines we saw last year, 65% down year yet last year in 2022. Worst year for the stock on record, and 2023 doesn't look like it's going to start off materially better. But for other technology stocks, you are seeing the benefit of lower yields. You have Amazon, Microsoft, and Apple all higher on the day, Anna.
So, Kaylee, then into the European session, and it's interesting what you're saying there about technology, because that's one of the sectors doing well here in Europe. Some of the sectors beaten up, of course, by the higher rates environment last year, actually doing pretty well today. So whether that's technology or real estate, those two sectors, along with travel and leisure, doing best out of the sector outlook. So stocks Europe 600 up by 1.6%. I pulled the FTSE 100 out. It is playing catch up from yesterday. European continental stocks were up by 1.7% on a day where London was closed. So London having to play catch up, and so as a result getting some of the best of the gains. And it's really broad-based. Around half an hour ago, only one stock was in negative territory. Now only 3 stocks in negative territory out of that FTSE 100. The stock rally coming despite, as Matt says, the strength that we're seeing in the dollar. The euro weakness, the strength in the dollar takes us to 105.39 right now. And we have had some interesting data out around the German inflation story, showing it coming off its peak in various regions of Germany. We get the national figure a little bit later on today. Then we get the Eurozone figure at the end of this week. So there's a real focus on whether that inflation figure has peaked. Christine Lagarde's comments, though, over the weekend certainly suggest ongoing focus on the inflation fight over at the ECB. And perhaps some of the reason for optimism around inflation and the battle there, natural gas prices coming down once again. We talked to our colleague Rachel Morrison earlier on in the hour, Kaylee, about this phenomenon. It seems the relatively milder weather over the winter so far setting us up, at least, or putting us in a good place, I guess, as we go into 2023.
All right, Anna, definitely a story we will watch this year. And speaking of the story for 2023, in this week's MLive Pulse survey, market participants weighed in on how exactly they see this year shaping up for markets. Here's a quick look at what a few of our guests had to say about their expectations.
When you have sharp movements in markets, those correlations rise. When you have sideways moving markets, as I anticipate is going to be the trend in 2023, that correlation will break down. And I think what you are going to see is investor flows being driven by market selection.
Our long-term models were very negative on equities at the beginning of this year. But the good thing about this correction that we've seen in the market, the good thing about valuations coming down, is that the setup right now is spitting out something like 5% returns per annum over the next 10 years.
Due to the fact that bonds have likely bottomed and rates have likely peaked in this cycle because markets are so anticipatory, then I do think that the 60-40 performance is going to improve next year.
Many in the market saw this as an opportunity to actually either top up existing positions or enter into positions in Micron in particular. And that's a view that we would share. This long-term structural growth story, by no stretch of the imagination, is that going away anytime soon.
So a comeback for the 60-40 portfolio, perhaps after its worst year since 2008 in 2022. So joining us now for more on the 2023 outlook is Hans Olsen. He is Fiduciary Trust CIO. Hans, Happy New Year to you. Thank you so much for joining us to kick off 2023. How are you thinking about how you want to split your allocation between stocks and bonds in this year?
Sure. I think, first of all, Happy New Year. I think the way that we're approaching it right now is that we have raised cash over the closing months, the closing second half, of 2022, in anticipation of what was going to be a rough back end of the year. And so we sourced that cash from both equities and fixed income because we thought both asset classes would suffer from the reset in interest rates that are ongoing. And as far as 2023 is concerned, I think you're right. We'll see a return to some good performance, somewhat reasonable positive performance out of the 60-40 stock bond portfolio, but it'll be back-end loaded if it happens this year. And that all will be a function of ultimately where interest rates land and in the effort of getting inflation down.
What do you expect in terms of inflation? We were talking about a Michael Burry tweet earlier where he said we're going to have a peak again, but then could see it drop down even to negative territory in the second half. I guess he's predicting a horrible recession where the Fed has to step in and cut rates and the government has to provide fiscal stimulus.
Yeah. It's an interesting question because I keep thinking that we will end, with the idea of rearming, reshoring, and restocking, which is an ongoing effort through the American economy. We'll see inflation settle in somewhere in 4 to 5%, so materially above where the Fed hopes it will be. But I think ultimately, if we get to a point where we get a real interest rate reasserting itself in the economy, that'll be the beginning of what normal looks like. So I'm not. I don't see a return to deflation. And I think the question about, do we have recession or not? It was interesting to note in the IMF note, was yesterday, where the director was talking about a third of the world's economy being in recession. She did note that the one exception was the United States, whether it would fall into recession or not, because our economy is so resilient.
Yeah, so that's still an open question then. Hans, good morning to you. If we do see inflation settle in the US at between 4 and 5% because of some of the trends that you mentioned, the reshoring, the restocking and the like, what is the impact on investment strategy of an inflation rate that is that high by recent standards but low by longer term standards, I suppose?
Yeah, that's a good point. You think about, you have both level and direction. So if you have an inflation rate, let's say it's 4%, but it's durably 4%, sort of stable at 4%, you can make money in that environment without a doubt, right? It's when you have inflation that's rising at a good clip that's problematic, and inflation that stays high. But if it's low and stable, and one could argue that a 4% stable inflation rate, while not perfect in the Fed's eyes, you can work with that. You can plan investment around that. And I think that's an important point for thinking about capital allocation on a longer term basis. So I think you can make, both in the equity market and the fixed income market, decent money in that environment.
We've talked a bit, Hans, this morning about how stocks are gaining this morning, despite the fact that we see a stronger dollar. Given that's your outlook for the US and where inflation settles, and that'll impact on the dollar, of course, how do you see that playing out? The stronger dollar that we've seen, the weaker dollar that some people anticipate, how does that play out for international investments?
Yeah, well, I think a stronger dollar, which I think is likely. I think we've seen peak dollar, and the reason that I say that is that you have the Europeans who that are working very hard to catch up with American central bank policy, and you even had, as you covered earlier, sort of questions around what the Bank of Japan was going to do as Kuroda leaves the post later in the year, and so you have global tightening, and so that interest rate differential with the dollar now, with the U.S. economies coming down, the dollar as the standout currency, I think we've hit this peak dollar, and we'll see the dollar weaken over the course of the year. And so as a result, that should help foreign investments, certainly from a dollar perspective. So what has been sort of a one-way trade over the last year, relatively speaking, I think will start to reverse itself in 2023, and foreign markets, both in the fixed income and eventually in the equity market, and eventually fixed income markets will become more appealing.
Okay, so that's all in fiat currencies, Hans. I noticed in the notes you sent over to us when you were talking about assets that are still overvalued, you mentioned crypto. Does crypto have any role to play for you in a multi-asset portfolio?
Yes, it's basically an avatar of that which should be avoided at all costs.
Okay.
Yeah, no, I just,
good advice.
It is. I think with the emergence of an interest rate again, the bar for successful investing goes up, and as a result, gold will struggle. As we saw last year, it could struggle again in the first half of this year. In crypto, there's a post-mortem on that needs to be done, and that probably plays out in 2023 as well.
Okay, a book still to be written then, Hans. Thank you very much, Hans Olsen of Fiduciary Trust. Thank you very much for joining us with your thoughts. And be sure to check out today's Big Take story, which gathers more than 500 calls from Wall Street strategists to help paint a picture of the year ahead. Look for that on Bloomberg.com or on the Bloomberg terminal.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if you're being honest, this is a plant that cannot hold on much longer in a changing climate.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons in New York and Anna Edwards in London. Now, kicking off the new year, Eurasia Group will be publishing its annual forecast of political risks in less than an hour on Bloomberg Surveillance. Eurasia Group's chairman, Cliff Kupchan, joins us now from Washington with a bit of a preview. And Cliff, I guess in terms of geopolitical issues, one of the biggest ones is going to be the war in Ukraine. Does Vladimir Putin, does Russia continue that war, or do you expect them to come to the table with some kind of agreement that provides us with a truce?
Well, Russia not only continues that war, I mean, look, two countries want the same land, so there's not going to be an end to this war anytime soon. Putin this year has no obvious way, no clear way to win the war. He is backed up in a corner, back against the wall. And we expect him to lash out with asymmetric warfare, warfare not on the battlefield. Nuclear threats, escalating nuclear threats that have a very bad outcome if two sides miscalculate, one side miscalculates. I'm also really worried about what could happen in the south if the Ukrainians make a breakthrough. I think Putin, small chance, but he really could use a tactical nuclear weapon. That's extremely worrisome. But otherwise, I think we're going to see mostly asymmetric. And by that, I mean cyber, hitting fiber optics cables. I still think, my theory of the case on Nord Stream is that the Russians did it. I know they're making repairs. I still think they're the only one with an incentive to do that. And possibly what I hear from my Russian colleagues is possibly hitting U.S. satellites that are engaged in the war. And that's extremely dangerous because we're talking about a war in space. So, no, I don't think the war is over. I think things are going to get much more serious this year.
Okay.
In those terms, yep.
And Cliff, worth pointing out that this time last year, you were saying at Eurasia that you thought if there were no concessions from the US-led West for Russia, then Russia will act, and they did. Right. We saw that call was entirely right. So you expect Russia to continue to lash out with what you call asymmetric warfare. Will Ukraine continue to enjoy Western support then in that context?
Yes, it will. I think Washington, the city I live in, is pretty much still focused on some form of victory. Victory as the Ukrainians define it, but the Ukrainians want everything back, including Crimea. So I think eventually we'll, in this town, again, go up the escalation ladder, providing longer range missiles, providing possibly tanks, and even possibly aircraft, F-16, which is what they really want over in Ukraine.
So
it's an escalatory atmosphere. Go ahead.
Well, obviously, Russia is one authoritative regime we could talk about, but there are many around the world. How do the links of those together come through in the 2023 top risks?
Well, thank you. That's one of our main themes, really, that a small number of people have accumulated a tremendous amount of power, and that has real implications for geopolitics. They're making these decisions, this crew, with limited information, with limited expert advice, and with no checks and balances. So as you draw across Russia to Xi Jinping in China, to Ali Khamenei in Iran, those are three countries that are pretty high on our risks that are going to be making bad decisions that impact global markets. If that happens in China, for example, we can talk about Xi if you want. That is extremely important for investors.
Okay, well, let's do that. Let's talk about China, because we actually heard from the new foreign minister, Qin Gang, overnight praising the Americans, talking about how he has been deeply impressed with the Americans he's interacted with and that he wants to help build a stronger relationship with the U.S. What do you make of that and the idea that there has been something of a warming of ties between these two largest economies in recent months?
I think since the last meeting between Xi and Biden, both sides have decided to put a floor under the volatility of the relationship, to try to at least, competition and cooperation, and that's a change for the better. But still, as we talk about in our report, it's maximum Xi right now for the 20th Party Congress. He is it in a big way. So that from COVID, where there's a real crisis going on, and that could get even worse if new strains emerge and there's no transparency, to the economy, where they really need good stewardship this year in the context of a weak global economy. They probably won't get it from Xi's crew, and that could lead to, again, a lot more policy volatility, even pain for markets.
Well, we heard a lot about the economy this morning. I was listening to Tom McKenzie on Bloomberg Radio say that the supply chain issues have really hurt China, the supply chain issues caused by Putin's war in Ukraine. Of course, they've been allies. Does that continue, Cliff, or does Xi grow tired of Putin's war in the East?
It continues. I think that my own view is that Xi is mortified by the war. Just can't stand it. But the cost of backing out of that, friendship with no limits, which certainly has limits, but the cost of backing out of that friendship is just too high for him. He needs a very strong relationship, with a nuclear superpower on his northern border, and Russia's just too convenient. This mutual balancing against the U.S. is just too good for Xi to back out of. So it'll continue.
Cliff, given that, but given also what you talked about earlier with the increased cooperation perhaps between the U.S. and China, how do you assess risks surrounding Taiwan?
I don't think risk surrounding Taiwan is very high at all. There's been a kind of a cottage industry about writing a war in Taiwan in this country, and I've kind of been part of it, but it is way overhyped. This will be a major war between two nuclear powers. Interdependence between the two countries is still massive. Neither can afford what would be mutual assured economic destruction. If China goes in, China still needs chips out of Taiwan. If they go in and blow TSMC, they're hurting themselves much worse than anybody else in the world. So for lots of reasons, that's just not on. And that is one of our red herrings this year, by the way.
Okay, good. Glad we identified it. Cliff, thanks very much for joining us. Eurasia Group Chairman Cliff Kupchan. And of course, next hour, you'll get more details coming up in the next hour. We'll reveal Eurasia's top risks with Eurasia Group founder and President Ian Bremmer. That conversation at 6:30 a.m. in New York, 11:30 a.m. in London. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Anna Edwards in London. Now let's take a quick look at what is ahead this week. Today begins a new era of divided government in the U.S. as Congress opens its new session with a Republican-controlled House. But questions remain about whether House Republican leader Kevin McCarthy will garner enough support to become House Speaker. Then later on today, Sam Bankman-Fried is expected to appear in a Manhattan federal court. Of course, fraud charges, what he is facing among others. Then on Wednesday, we get the FOMC meeting minutes for December at 2 p.m., expecting to see policymakers concerned that the labor market is not cooling fast enough. And we'll be getting plenty of labor market data this week. JOLTS jobs openings are released on Wednesday, with initial jobless claims following that on Thursday. And Friday is Jobs Day in the U.S. The focus of the December jobs report will be on average hourly earnings, which could play a disproportionately large role in the next Fed decision. So basically, to sum it up, Matt, it's all going to be about the labor market, at least in the beginning of 2023, after it was about inflation in 2022.
Yeah, absolutely. And right now, 3.7% is where unemployment stands. And the question is, will the Fed, with its tightening cycle, be able to raise the unemployment rate, raise the so-called NAIRU to a level that's no longer inflationary? Is the Phillips curve real, and will it be used? Anna?
Yeah, absolutely. A lot riding on the data then that we get this week, and similar data in the months ahead on the jobs side. And interesting to see how those expectations around Fed rate cuts then, Kaylee, evolve as we start 2023, because right now the market is expecting that we will pivot towards some cuts by the end of this year. But I speak to a lot of guests who say actually they're not sure that's going to happen.
Yeah, I think that is going to be one of the pivotal questions, considering the consensus call for risk assets this year seems to be it's going to get worse in this first half, then get better in the second half. But how much of that is predicated on some kind of policy pivot from the Federal Reserve, and what happens if that doesn't materialize?
Yeah, all those worries, though, for another day, perhaps. Risk assets rising, U.S. futures rising, European stocks rising early in January. That is it for Early Edition. Surveillance is ahead. They'll be hearing from Ian Bremmer of Eurasia Group, taking you through the key risks for this year ahead. This is Bloomberg.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long or persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation, and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
2023 could continue to be pretty challenging for stocks.
Fixed income is back in 2023. You don't have to go out 10 years.
Q1 will be lumpy and bumpy, and I think China's reopening is not going to go as smoothly as people think.
As we move into 23, we're going to start the year with a coupon.
All in all, wages are likely to rise faster than prices in 2023. So I think the purchasing power is going to be there for consumers.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Do you remember how to do this? Because clearly I don't.
Well, did you, how was the bus ride to Cornwall?
Did I get a bus?
You got a
Is
bus.
that the story you told?
It broke down halfway.
I went to Cornwall, apparently. Is this another one of TK's stories?
Good morning, Happy New Year.
Okay, good morning to you.
Yes.
Hello 2023, live from New York City for our audience worldwide with Tom Keene, Lisa Abramowitz, I'm Jonathan Farrow. Futures up right now by about 0.9% on the S&P. We'll catch up with TK in just a moment. I'll try and remember how to do this over the next 3-4 hours. Bramo, big question I've got to say coming into 23, hitting the ground running. It's not about the US data later this week. We'll talk about that. It's about China reopening and what we can expect from Chinese data in the future off the back of the decisions made over the last couple of weeks.
That's well said, because the data that we're getting is backward-looking, and it is horrendous. If you look at, for example, China Beige Book, it came out and actually was a prediction of a contraction in the fourth quarter for Chinese economy. That said, look at the subway activity data.
I saw the same thing.
That, to me, really says so much. We were looking at that in New York City. We were looking at that in LA in the aftermath of the pandemic, and that tells a different story.
A few questions here. Demand side, let's talk about that. Where's the demand going to show up? Is it going to be in the commodity market where people expect it to show up? Or have they stockpiled enough commodities through 2022 to maybe blunt that impact in the months to come? I don't know. The supply side question is more interesting to me. Are we going to get some supply side relief? Look at what's happening with Foxconn and Apple, and we'll discuss that in a couple of minutes' time. Or are we going to get supply side dislocations off the back of a boom in demand back into the goods sector, into places where we didn't see stockpiling?
It's a great question. It's very complicated. You already see an easing in some of the supply chain lines. Yes, the iPhone, but also in some of the German manufacturing data coming in better than expected. So at what point do we start to see that come through the crude market, come through the natural gas market, in perhaps a way that's a little bit more pressure for the
If you would like the guide to the next week or so, we have payrolls on Friday. Then after that, looking ahead to next week, you've got CPI data on the 12th, is it? Then on the 13th, we get JP Morgan earnings as well. So you get your data, and then you get your earnings, and we'll find out whether we're going to get the kitchen sink for guidance for the year ahead from the C-suite in corporate America.
Can they give a kitchen sink approach if we have no clue? Honestly, how much are we going to get? I mean, honestly, this feels like a black box to me. I mean, honestly, Michael Burry coming out and saying it's going to be a whipsaw inflation, it's going to come back, and other people saying just buy bonds, and that's what everybody else is doing this morning. I mean, honestly, it's incredibly conflicting.
We're trying to price a recovery to a recession that hasn't materialized yet.
Exactly. Go figure.
Figure that out.
You can go back to sleep.
Futures right now. up about 1% on the S&P 500. I was surprised to see this in the bond market this morning, just logging onto the Bloomberg, just to see this bid coming into treasuries. Lisa, yields down by 13 basis points on a 10-year, 374 this morning.
Yeah, and how much is this based on what we saw over in Germany, that we saw better than expected data? We also saw a bigger than expected decline in some of the inflation read. At the same time, you're right. Maybe it's just that everyone said buy bonds. Everyone came back from holiday and said, okay, let's do it. Let's talk about what's going to happen in the week ahead, because honestly, today, everyone's just getting back to the office in the U.S. and getting their feet under them. On Wednesday, we get U.S. jobs opening data as well as Fed meeting minutes. That's at 10 a.m. and 2 p.m. respectively. The JOLTS data is going to be interesting. How much does it continue to come down? It is a jobs-focused kind of week. On Thursday, we got ADP employment at 8:15 and initial jobless claims at 8:30. Do we start to see a tick up in initial jobless claims? Because if you look at the longer-term track record, it does look like someone died and was put on one of those heart monitors. I mean, honestly, it has not ticked up, and you have to expect that you'd start to see that if
Only you could say something like that.
I mean, come on. It's just, but that's a good thing, right?
Just
we don't want
suitably depressing. From you, look, I'm with you. For all the talk of recession, we've got 1.7 jobs open for everyone looking for one. According to the data, and we can talk about whether that data is worth looking at in that way. Jobless claims in and around 200K doesn't scream imminent disaster in the economy, does it?
Not at all. Although I do think that probably on Friday is the more important indicator. Not only do we get non-farm payrolls at 8:30 a.m., we get ISM Services Index for the December at 10, but the hourly earnings, do you start to see it come down in terms of how much they're going up? That might be a more telling indicator, John, than even the just overall numbers of people getting hired or unemployed or job openings, because that gives a sense of how much real pressure there is in the market.
Came into the building this morning, had no idea where Tom was. I was told he was down at Eurasia Group and he'd be doing a top risk thing again in 2023. So TK joins us now from Eurasia headquarters. TK, just abandoning us on the first day of 2023.
Yeah, Ian Bremmer out with his first top risk for the year, John, and that is that the Bramo gloom will drift into 2023. That's certainly what I've heard the last number of minutes. John, an annual tradition for surveillance to join Dr. Bremmer and Eurasia Group in celebration of their 25th year. Their top risks are a must-read. We're going to cover that, of course, on the war in Ukraine. Bill Dudley will join us with Dr. Bremmer, the former president of the Federal Reserve System of New York. And very much so, we will lead with China. Looking forward to talking to Dr. Bremmer, as you and Lisa mentioned, on China. We'll do that at the 6:30 moment.
That coverage will start in about 25 minutes. Looking forward to TK. I've missed you, Tom. Tom Keane, over at Eurasia HQ in New York. I'm not sure if that sentiment is shared.
I think Tom? It was. I think he was about to say it, but it was just on a delay, so they cut it off and nobody could hear it.
I waited and then they just killed his mic. That's what I like to think anyway. Christian Muller-Glissman joins us now, Managing Director for Portfolio Strategy at Goldman Sachs. Christian, fantastic to catch up with you, sir. Happy New Year. Let's look ahead to the year ahead. Can you tell me how big is the gap right now between what you expect and what's priced in this market?
Yeah, happy New Year to you as well. I mean, listen, I think not much happened over the Christmas period, which still leaves us with the same problem. Risk premia are very low. And I think risks are high. I think we are going to shift a bit from the inflation risk side to the growth risk side. You mentioned China. I think that's one area which could drive positive growth surprises eventually, but there's still a lot of uncertainty on the growth picture globally. So I think we're in the same spot where I think we see equities down in the near term, possibly recovering towards the end of the year. But I think the key challenge is risk premia are very low. Equity risk premia, credit spreads, the VIX, and that just doesn't leave us for a good start of the year.
Christian, you said that things really haven't changed, but one thing did change. It was incredibly warm over the past couple of weeks. And I know that sounds like, okay, you had nothing else to focus on, but yes, and it has really allowed there to be an easing from some of the energy infrastructure, certainly in Europe. Doesn't that give you a more positive tone that some of the worst case scenarios haven't come to pass at all? And in fact, it's been better than expected almost across the board in every potential outcome.
Yeah, no, I think that's fair. I think certainly the kind of warm winter is something that can provide relief. We see that in the currency markets, like the pound, the euro has been remarkably strong over the holiday period, and the dollar has been weak. And a weaker dollar generally is also risk on. So I think it does feel like that is a positive. I'm not sure if I would extrapolate that and would make an investment thesis around that. The big challenge you always have is markets are priced for that already. It does feel like, as I mentioned, the currency markets have reflected that a bit. Volatility is low, credit spreads are low. So I always like the idea of mixing asymmetry with macro momentum. And I think macro momentum, as you said, has been maybe a bit more supportive in certain spots, but the asymmetry to chase that momentum right now doesn't look particularly good.
And Christian, you're not alone in believing that and seeing a better outcome potentially for bonds than stocks, that there's an asymmetry of risk here. And if you go into some of the havens, traditionally, it is better. But as John pointed out, we are seeing that haven bid today. We are seeing people pour into bonds. We're seeing people pour into the dollar. At what point do you say, okay, it's already priced in? What are the sort of the triggers to know, okay, this trades up?
Yeah, I mean, listen, yields have gone up in the last 2-3 weeks. I mean, real yields certainly in the US. And that means to me, to some extent, the fixed income opportunity is still there. I think at the margin, we are leaning to up in quality type credit. So we're not necessarily saying we would chase down the line riskier credits. But at this juncture, like tips, investment grade credit type yields, we think are still attractive. So there, the valuation is to some extent less of a concern. But you're right. I think this kind of outlook period has shown a bit of consensus with regards to fixed income. The other thing that does kind of give me a bit of comfort is the flows. I don't think we've seen a major rotation in flows out of equities into bonds, kind of broadly into fixed income. It's been reasonably slow. And that also tells me that we're not necessarily at the end yet.
Christian, can we just get into the China questions around demand and around supply as well, and start with demand? Where do you expect that demand to show up? Where is that Chinese capital going to be deployed? Where does the consumer go? Does it get spent at home? Does it get spent abroad? How are you and the team thinking about that?
Yeah, it's a really good question. I think we've been leaning towards the slightly more bearish story here with regards to the global economy, in the sense that we still have relatively tight commodity markets. And if China reopens forcefully and fast, you could see a bit of a replay of the commodity-led inflation, which we had coming into this year or the last year. So to some extent, we're kind of a bit more worried that it could reignite the commodity strength, which then has the kind of knock-on effects on inflation. With the travel bans, which have been put into place, the kind of exposure to global travel services and these type of areas is a bit more limited. So the Chinese economy itself seems to be very focused on growth, and there you're likely to see a decent recovery. But it could be very bumpy, as we learned in the last few days. Mobility has picked up from very low levels, and it could be very inward focused, not easy to invest.
So, Christian, I think the supply side is maybe the more complex question to answer right now. Do you see this as something that develops into supply chain relief, or further supply chain dislocations off the back of that boom in demand?
Yeah, I think it's quite interesting. Our US economists, they actually expect goods inflation to turn negative this year. So I think on the goods side and with regards to supply chains, there is likely to be significant relief, and there's going to be less inflationary risk coming from goods and supply chains, it seems. And with China reopening, you could argue there's even more relief on that front. So it's still the services sector where there's a source of inflation, and the commodities parts. And from that perspective, that's more where we're looking for the data. You mentioned already, labor market data in the US is still critical, and anything related to commodities, if it's the energy crisis in Europe, or if it's China reopening, crowding out commodity markets, these are the things we're watching on the supply side.
Hey, Christian, this was great. Fantastic to kick off 23 with you, sir. Christian Muller-Glissman there of Goldman Sachs. There's going to be a massive debate around that, Bramo, about what actually develops in the year ahead.
Especially because it is so bifurcated between services and goods, and a lot of people expecting this disinflationary, outright deflation in goods. Does that mean that you get to this sort of rebound, kind of boomerang inflation later on?
Did you hear the IMF Managing Director, CBS?
I did.
Can you make sense of that? He said the three big economies, US, EU, China, are all slowing down simultaneously. Are they?
That's a great question. It's a really great question. They're slowing down, yes, but have we seen the nadir for China already?
Kelly Kaminsky coming up in the next hour. Looking forward to that conversation about 7 a.m. Eastern time. So let's call it 48 minutes away. Then TK, Tom Keene, sitting down with Ian Bremmer of Eurasia Group. We'll catch up with them in about 28 minutes. Live from New York City. Happy to be back. Happy New Year to you all. Future's up. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In China, the economy ended the year in a major slump. Business and consumer spending plunged in December, and more disruption is likely in the coming months as COVID infections surge across the country. Activity in China's services sector fell the most in almost 3 years. Ukraine struck a Russian military facility in an occupied town, killing at least 63 troops. It's one of the deadliest losses acknowledged by Moscow. Russia says the facility was hit by 4 U.S.-made HIMARS rockets. The U.S. is in talks with South Korea on ways to keep Kim Jong-un's regime from using nuclear weapons. The two countries are planning for a range of scenarios to deter North Korea. South Korea is seeking a greater role in managing atomic weapons on the Korean peninsula, but President Biden says he is not discussing joint nuclear exercises with South Korea. In the National Football League, Buffalo Bills player Damar Hamlin suffered a cardiac arrest and collapsed on the field during a game with the Cincinnati Bengals. Hamlin is in critical condition in the Cincinnati hospital. Stunned teammates surrounded him while he was being treated by doctors and paramedics. The game was postponed. Global news, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
They've raised their inflation forecast.
Firm and immediate action.
He wants to destroy my country.
Elon Musk to buy Twitter.
Overturned Roe versus Wade.
Boris Johnson will call it
Donald
quits.
Trump's plan to overturn the
unprecedented search warrant at the home of our former
Queen
president.
Elizabeth has died.
Xi Jinping got his third consecutive
The
term.
pound falls to an all-time low.
The shortest ever serving prime minister.
Presidents Biden and Xi shake hands.
FTX filed for bankruptcy.
The red wave that never was.
Protesting his zero COVID policy.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. It's the first jobs report of the new year.
The labor market has not cracked.
A lot of that's a function of labor shortages.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Can you walk us through how the Federal Reserve conversation has reset?
We're still seeing a strong economy, so the Fed has to do more.
Why are people so confident that there is going to be some massive deceleration?
I just don't see the evidence. This could go a lot of different ways.
The December jobs report, Friday on Bloomberg Television and Radio.
Working relationship with Kevin McCarthy, yes.
Do you think he's going to get the votes to be Speaker? You know,
I would be surprised if he doesn't. If he gets 218 votes, has the ability to put together the votes to be the leader of the party, and he will then be tested as to whether or not he can lead. You know, he's worked pretty hard at it, and it appears to me that he will be the Speaker.
If he gets 218 votes, that was Representative Steny Hoyer there, the House Majority Leader, to CNN. Live from New York City this morning. Good morning to you. Happy New Year. Let's get some price action for you. Your equity market positive. A lift on S&P 500 futures up 0.8% after a bruising, punishing 2022. How many different ways have we described that over the last couple of weeks?
Brutal,
What were we down by,
devastating.
Bramo? Down by that
20%.
19%? 19%
on the S&P, but
Ugly.
the NASDAQ even more significant.
Made even more ugly by the fact that the bond market participated in that sell-off as well.
Yeah.
And as we reset coming into a new year, I think that's where the question lies for everyone in fixed income. Is this the moment where you stop getting that move in tandem between equities and bonds, and that correlation, the one we're used to, reasserts itself?
The issue is that that's the consensus right now, and you're seeing that play out in some of the price action this morning, that bonds have an actual, some kind of valuation bid for individuals, whereas stocks perhaps not so much. How long does that last, though? How much is that really rooted in goods disinflation that we don't necessarily see in services?
We'll talk about that later. I want to talk about China reopening as well. Did you see what the spokeswoman for the foreign ministry in China said about restrictions being put up for Chinese travelers out of China into places like Europe, the United States? I'll read the quote. We believe that some countries' entry restrictions targeting only China lack scientific basis, and some excessive measures are unacceptable. Now, that's kind of dripping with irony for a lot of people waking up to read that, given what China's been doing over the last 2.5 years, Lisa.
No, yes, that is. I think a lot of people would say this is pretty rich, considering that other people have accused perhaps China's measures as not particularly scientific and not necessarily rooted in anything else. But I would say this, it is notable to me, aside from just the irony and the richness here, there is an aspect of what kind of tit for tat you end up getting with China as they try to communicate a very convoluted message to their population.
I've heard a lot of people tell me already this morning, look at the weak data out of China, look at the weak data out of China. I looked at the weak data out of China. I just think it's more important to think about where the data is going to be 6 months from now, off the back of the decisions that have been made over the last couple of weeks. Do we get that ugly phase of data like we got out of Europe, where social mobility starts to turn down because you get people self-sanctioning effectively off the back of a rise in sickness, you get people calling gout, have all those kind of issues, and then slowly, in the months still to come, things start to rebound, and then they rebound pretty quickly.
The people who were ahead of that and looking at the mobility data in the US, in Europe, they won. Remember, they were the ones who were ahead of a lot of the increase in economic data. So can you have the same kind of trade in China when there is a very different economic backdrop as well? It's not just COVID that's going on.
It's real estate too.
Yeah.
So how much weakness do we need to look through? We'll pick up on that a little bit later. As I said about 10 minutes ago, TK is going to join us in about 10, 11 minutes time. He's going to sit down with Ian Bremer of Eurasia Group on the top risk. I understand he's going to lead with a lot of questions on China. Right here in New York, we look down to D.C. with Anne-Marie Hordern. She joins us now, our Bloomberg Washington correspondent. MH, fantastic to catch up with you. Let's start with that speaker vote face down, showdown for Kevin McCarthy a little bit later. Will he get 218?
Well, we just don't know yet, Jonathan, and that's what's so scary going into this vote for Kevin McCarthy. Remember, this is the first order of business for the new Congress, even before new members are sworn in, and Washington went to bed not knowing if he was able to clinch the votes needed. It's 218 if every member is present. If not every member is present, it could just be a majority. That's actually happened in the past with former speakers Pelosi, Boehner, Newt Gingrich. The issue McCarthy has, though, is that really this is infighting of the Republican Party. So even if he's able to clinch the speakership today, or potentially the next few days, because this will just continue until there is a speaker, unless they adjourn Congress, then this just paves the way and doesn't really exude a lot of confidence to the Republican Party, because he's already having to make some concessions.
Anne-Marie, what's the significance of this in terms of where the fissures are in the Republican Party and where the battle lines are being drawn?
Well, it just shows how much hold you have of these hard right representatives, really the Freedom Caucus. You have 5 who are coming out. These are really the no-never Kevins. You have others that really support Kevin McCarthy that are actually donating some pins that say, okay, like, okay, we're going for Kevin. So the never Kevins and the always Kevins. But these individuals of the Freedom Caucus, you have 5 who are saying outright, we are not going to vote for him. And then you have 9 signing this letter saying, we saw some of the rule changes he wants to make. One of the biggest concessions is making it a little bit easier to have a no confidence vote. But they're saying that there isn't enough concessions, and a lot of them aren't specific. So they want to see more proof before even he takes that vote to be Speaker of the House. But what this really shows is that down the line, it is going to be much easier for these individuals to have a hold on the party because they have such a slim majority.
So what does this mean for policy, Anne-Marie? And there's a lot of different political issues coming up in the next couple of months. Does this inform what the Republican power is going to be, even as their majority in-house?
I think what you can see in terms of policy down the line, and really September is going to be key, right? They have to sign off on another spending package, or you can have a government shutdown. These individuals are really going to push for more hard conservative policies in terms of taxes. They want to make sure that the Trump-era tax cuts, which in a few years will be ghostlighted, they want to make sure that those continue. They also want to make sure that they are driving a very hard bargain when it comes to the fact that if the Democrats want to raise the debt ceiling, and obviously that's going to have to happen for a nation to conduct daily and normal financial practices, that they want to make sure there are concessions from the Democrats when it comes to spending. So that's going to be one of the key areas to watch.
MH, just quickly before you run, just a bit of a curveball. Did Secretary Buttigieg get to celebrate Christmas over the last week or not? Because I imagine the Department of Transportation was incredibly busy over the last several weeks.
I think it's fair to say his phone was blowing up, given the fact that so many individuals around the country were stranded in airports, not able to get home this Christmas. And that is one that he is still going to be dealing with this January 3rd.
Let's see the consequences of this, Bramo, for sure, in the months still to come. I heard some people talking about consolidation between JetBlue and Spirit. Is that going to get some pushback now off the back of what we experienced over the holidays?
Or not, if they can have some better, technological systems in play that don't leave people
may well
stranded.
Be their
I mean,
argument.
honestly, you could have either argument. I think the bigger questions for me are dividend payments, whether some of these airline companies can pay dividends without investing in better technological systems and perhaps better contracts with some of their workers. And then there's a question of what kind of responsibility is there for compensation to people who are left stranded in places, not just this, but like also, for example, in Atlanta for a weekend when you could otherwise have
Are you talking about?
I'm just
what
kidding.
airline are you talking
No,
about? You're talking about last year and your experience with that airline down in
whatever.
Atlanta?
Things
well, you brought it up. I didn't bring it up.
But
Can I
will
thank
say
Anne-Marie
this.
quickly?
Go ahead.
AMH, thank you. Carry on,
Okay.
Bramo, please.
I will say, I actually went to Denver, and I was not flying on Southwest. You could just see cancel.
It's
It
ugly.
was just like, it was horrible. I can't imagine.
These numbers, I went through them this morning, and thanks to the team here at Bloomberg for putting them together. According to FlightAware data, 15,700 flights. Southwest cancelled more than 15,700 flights. And you want the percentage? Almost 51% of its total flights cancelled December 22nd through December 29th. So that is brutal.
I was in the airport, and this person who is a very experienced member of the flight world said, it's kind of fascinating to watch how badly this all went. It was just a cascade of horror. I mean, it was one terrible thing after another. And the fact that they couldn't get it back up and running because of the point-to-point system rather than a spoken hub kind of system just highlighted how ridiculous it was. They were passing around pieces of paper to tell people where they were going to be flying to at different points. And it was incredible. It was absolutely incredible.
Would you trust them with your holiday travel next year? We'll see.
Well, for what price, first of all?
Well, that's it, isn't it?
And how many free drink vouchers?
You think that's what it takes?
I was actually
for me to put my holidays at risk for free
Not for
drink
you.
vouching. You think that's what it gets?
I just wonder how many perks they can actually offer people to bring them back with low prices, free drink vouchers.
The free drink vouchers thing, I just find nuts. I don't get it. What is it with drinking in airports?
Well, I think it's just such a miserable experience.
There's no social rules that apply. You just
Yes,
start
it's
drinking
true.
immediately, regardless of the time.
Absolutely, because it's somewhere, it's always 5 p.m., literally, and you might be flying there.
Ian Bremmer coming up next with Tom Keene from New York. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Live from New York City, good morning to you. Happy New Year. Here's the price action to kick off trading in 2023. Equities with a lift. I know many of you want to see a whole lot more of this after 2022. Equities up by 0.8% on the S&P. On the Nasdaq 100, up by, let's call it 1% higher. On the Russell, we advanced by more than 1% as well. In the bond market, 2s, 10s and 30s look like this. And I said it earlier, I'll say it again. I was surprised to see it. Yields at the front end down by about 7 basis points, 435. On the 10-year, 375.20. Yields down by more than 12 basis points. Maybe look to Europe. If they say CPI out of Germany, get this regional breakdown of CPI in Germany, then you get the headline for the whole country in about an hour and 30 minutes. And that's come in across the board, regionally speaking. So maybe that's contributing to this bid we see in the bond market, and maybe it contributes to this as well in the FX market. Euro dollar pulling back by 1.3%. Lisa, 105.26 on euro dollar this morning.
I'm not sure how it actually moves over to the strength in the dollar, because you would think that there'd actually be strength in the euro. It might mean that the ECB might not have to go as far if you are seeing some sort of disinflation. But what you are seeing here, and this goes to your question earlier, John, is the benefits of perhaps a bit of a reopening in China. Not a reopening, say, per se, in terms of just abandoning COVID-0, but the upside after the COVID spikes in some of the cities like Beijing and what that's doing to some of the supply chains.
A big story ahead. The geopolitics of this as well, just that back and forth between the foreign ministry over travel restrictions, I find.
You just want to keep going after that.
No, I just think, like, come
it's
on.
a bit rich.
It's a little bit rich.
A little bit rich.
Just a little bit, yeah. Tom Keene with Ian Bremer of Eurasia Group, the founder and president at Eurasia HQ. Morning, Tom.
John and Lisa, good morning to you. And it is what we do at the beginning of the year. We start strong with the top risks of Eurasia Group. It is a must-read 27 pages of brilliance, far too optimistic this year on the comparative strength of America. And joining us with a brief throughout surveillance this morning, Ian Bremer. Bill Dudley will join us on a divided America. We'll do that in a bit. But right now, not a divided China. Xi is at maximum power. Does it give way in 2023? Does his power after that Congress, Dr. Bremer, does it ebb?
It doesn't. And good to be with you, Tom. Happy New Year to you. It's always good to be kicking this off with you. You know, there's no question that both for China as the second largest economy in the world, but also with Xi Jinping having consolidated so much power in his hands and using it in ways that are capricious and are not in any way transparent. The global economy has never experienced anything like that. That level of uncertainty in the persona of one human being. We've seen it with the decision to do a complete 180-degree volte-face with the pandemic and zero COVID. We've seen it with $1 trillion off of market value of Chinese tech stocks because Xi Jinping decided that he was going to squeeze them. That level of uncertainty as China reopens their economy this year with no level of data that we used to get 5, 10 years ago from the Chinese even is an enormously concerning issue.
This is important, and this goes to your colleague in crime on this, Elizabeth Economy at CFR, now as Secretary Raimondo at Congress. Economy told me years ago, don't overestimate Xi's power. Have we seen the maximum? Have we brought down, do we see him weaken, particularly off the COVID disaster?
We see China weaken a little bit on the global stage. Certainly the lessons they're taking for Taiwan, now that they've seen the United States and NATO in Ukraine, the lessons they're taking from concerns about American economic strength vis-a-vis China on semiconductors, for example, on the ability and willingness to impose export controls, and the fact that the Chinese have sat on their hands. Xi Jinping is not in the same geopolitical position he was in before the pandemic started, but politically inside China, he is only stronger. And that is the nature of the risk for 2023.
How does it permeate? Now, you lead with Russia in the top 10 risks, but how does China permeate out to all the other thinkings of the top risks this year? They just seem to dominate every conversation.
Well, it's not that the Chinese do it, it's something very specific does, which is that in a time that the United States democracy and economy is actually coming out more resilient and stronger than anyone out there would have imagined 1, 2, 3 years ago, we are seeing around the world a significant number of super empowered individuals who aren't getting great inputs from experts, who are able to act with impunity, and are not getting what they want in various ways on the global stage. Putin is one, Xi is another, the Iranian supreme leader is a third, and a small handful of tech centibillionaires are a fourth. And those individuals are driving a discommensurate amount of global risk in the marketplace right now.
Let's look at your work. G0, the concept of G20, G8, G7, down to a codified Bremer phrase, G0, or much more importantly for Americans, us versus them, is the basic drama out there. How do we prosecute in 2023 a foreign policy with Xi? Forget about Putin. How do we prosecute a foreign policy with China that gets something done 12 months from now?
Well, two different ways. On the competitive side, you lean into American strength, which turns out to be national security broadly defined. So in the same way that the Germans have made mistakes for decades, and the Europeans writ large, and letting too much of their energy security lean on Russia, the Americans have let too much of our technology national security lean on Taiwan 100 miles away from the mainland. Now, what we are now trying to do, not just for the United States, but with allies as well, is say we're going to redress that. We're going to redress it because of national security. So you, the Japanese, you, the South Koreans, you, the EU, the UK, the Canadians, you're all going to be with us on these export controls for anything the Chinese could use that would threaten our national security directly. And that's a policy that will align the G7 more broadly on China. That's important. But at the same time, Biden does not want to be in a Cold War with the Chinese. He doesn't want to fight over Taiwan. And he doesn't want the impact of competition on national security to bleed out into the broader economic interdependence of the two countries.
I'm looking for something new here, and I haven't gotten it from Secretary Blinken. I don't think I've gotten it from the Biden administration. Let's go back to something like the military-industrial complex. This is back when Tulane had terrible football, and they won against
a year ago?
Yeah, a year ago. They stunned USC last night, which was great to see. But the shock of Tulane football, I'm looking for a shock in the Bremer world. In your top risks, what's the thing our viewers and listeners have to look for 6 months and 12 months from now?
Well, the shock that comes from a Chinese leader that is making policies. I mean, the end of zero COVID, a lot of people thought that it was going to be incremental after he secured power for that unprecedented third term in the party Congress. He didn't move away from it at all. No, it shocked everyone. No one was expecting this even 3 months ago, even 2 months ago. Why? In response to sudden demonstrations, the information got to him, and he, as an individual dictator of the second largest economy of the world, made that decision. We're going to see more uncertainty of that kind from the most powerful individual on planet Earth in 2023. Putin is in a corner.
I want to finish up here on China because we're going to talk to Bill Dudley later. We're going to talk to Mr. Rudd of Australia later. And of course, focus on Europe. We'll do that, folks, here in a bit with Carl Bildt. Okay, fine. But is the chemistry of China changed? The history is It's city-states like Shanghai and the new Hong Kong and all that versus a federal Beijing.
That's right, Jay.
Is that traditional calculus still in place?
Haven't seen it since Mao, what's happening right now. And at the time of Mao, the enormous amount of uncertainty in China didn't matter to the global economy. They weren't interconnected to it, and they were vastly less powerful. We today have the same level of concentration of power that you had during some of the worst episodes, chapters of Chinese history.
How should the U.S. respond to that concentration, the autocratic power?
With confidence, but also with strategic patience. In other words, take shots when you know they are important with allies strategically. The new policy that you see from Biden is on semiconductors and export controls.
Right.
That is containment at the sea change. But in other areas of the economy, don't allow that to dictate what you're doing.
We've got 1 minute here. We've got to get back to John and Lisa on the markets. Very, very importantly here, do you see a rekindling of what I'm going to call from World War II a MacArthur isolationism?
No, not at all. Not at all.
The Republicans don't want that?
It's not that they don't want it. It's that everyone that throws money around in the United States strongly wants to ensure that doesn't happen. Furthermore, no American allies on the global stage want it. Not one. Not one. Not the Japanese, not the Europeans. Biden cares about that.
30 seconds. John Farrell demanded I ask you this question. You nailed Merkel in Germany 2 risks ago, top 10 risks ago. Did Merkel fail in Germany? Did Merkel, is the reason we're where we are in Europe right now to tease to Carl Bildt, is it because Merkel failed?
Merkel failed on energy policy, and now they are paying the price for that. The European Union is stronger today in part because of work that Merkel did. So you have to give her a middling grade.
That's a tease of what we're going to do with Dr. Bremer here. Eurasia Group, they celebrate their 25th anniversary, and very importantly, their top 10 risks. And John, the 11th risk that Eurasia Group came up with was that Tottenham would somehow find an offense.
Have you got some match analysis from Eurasia Group HQ, Tom? What's the match review?
It's out there. The match review is kick the ball from far out.
Okay.
Aston Villa killed it that.
We're looking forward to the coverage through this morning.
Risk.
TK, fantastic work as always with the Eurasia Group President Ian Bremer. Stay tuned. More still to come from Eurasia throughout the morning, including interviews with Carl Bildt, the former Prime Minister of Sweden. We'll catch up with Bill Dudley, good friend of this programme, the former New York Fed President, Kevin Rudd, former Australian Prime Minister, coming up a little bit later as well. Looking forward to all of that. Bramo, just on China and what's going to happen with the Fed. And we've barely mentioned the Federal Reserve through the first 40 minutes of programming. So for those of you interested, first meeting of the year starts the end of this month. Decision the 1st of next month.
I think there probably are a lot of people who are very happy that it took this long for us to mention the Federal Reserve. I do wonder whether this year it's actually going to take a back seat in some respects, just simply because the real economy has to take over. What happens if they just stop hiking and we stop, obsessing over their every move, and we actually just start focusing on...
Oh, you think we might be able to?
I think
Can I give a shout out to Anna Wong of Bloomberg Economics, who last summer said that the terminal rate could hit 5, and I think a lot of people were still laughing at the time, and here we are talking about a terminal rate likely to hit 5 at the Federal Reserve this year. Yeah, and I think that a lot of people are expecting it to stop there. I don't know if we're going to start to hear, and I suspect that we will, a shift away from some of the tone that we're going to have to overshoot to 5.5% or 6%. And I'm very curious what Bill Dudley has to say on that, because there's a feeling that perhaps the price levels are really coming down faster than people expected on the good side. We'll see. We'll get CPI next week on the 12th. Then you get some earnings from JP Morgan on the 13th. Before we get to all that good stuff, you've got payrolls coming up this Friday. Equity futures right now on the S&P up 0.8% on the S&P 500. Yields are coming in. Big bid into the bond market to kick off 2023. Yields down 12 basis points. Your 10-year, 3.75.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. On Capitol Hill, Kevin McCarthy's chances of becoming Speaker of the House remain in doubt as Republicans prepare to take control of the chamber. The GOP will hold only a slender majority when the new Congress convenes today. McCarthy can't afford to lose more than 4 Republican votes, and he's opposed by a number of hardline conservatives. IMF Managing Director Kristalina Georgieva expects a third of the world economy to be in a recession this year. She told CBS News that's because the 3 big economies, the U.S., the EU, and China, are slowing down at the same time. But Georgieva says that if the resilience of the U.S. labor market holds, that would help the world get through a difficult year. More troubles for UK Prime Minister Rishi Sunak. British rail workers will walk off the job much of the week. They'll strike for 5 days starting Wednesday. Nurses and ambulance drivers, they plan to strike later in the month. Unions are demanding bigger pay hikes to deal with record inflation. In China, Foxconn has bought the world's largest iPhone plant back to about 90% peak capacity. That suggests that Apple's biggest production partner now has enough workers despite a COVID outbreak and a staff upheaval. In November, thousands of workers at the facility either left or staged protests against extreme COVID restrictions. And pro rally driving legend Ken Block has died in a snowmobiling accident near his home in Utah. Block co-founded the skateboard brand DC Shoes. Later, he began driving rally cars and revolutionized motorsports filmmaking. Ken Block was 55. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Expect 1/3 of the world economy to be in recession. For most of the world economy, this is going to be a tough year, tougher than the year we leave behind. Why? Because the three big economies, US, EU, China, are all slowing down simultaneously.
That was the IMF Managing Director speaking to CBS over the weekend. Equity futures right now rolling over. We're positive still, but we were up by about 1% on the S&P. Not so long ago, about 20 minutes ago. On the S&P right now, we're up by 0.4%. There's that line on China slowing down from the IMF Managing Director. I mean, Lisa, sure. But for how long and how quickly are we going to bounce back later this year?
Right. Have we already seen the worst of it? And if that's the case, what kind of offset does that give to emerging markets? And ironically, a lot of investors are betting against Kristalina Georgieva and saying, actually, this is the place to bet. Exactly.
Never.
Okay, you're dripping with
Great
sarcasm
start
this morning.
to 23. Tom Keane at Eurasia Group HQ with Ian Bremmer and a special guest. Hey, TK.
John Farrow, thank you so much. This is the lead of the top risk this year for Eurasia Group, and no surprise, it is on Mr. Putin and on Russia. With us, Dr. Bremmer, and joining us as well, someone with a European and Russian perspective. Carl Bildt is the former Prime Minister of Sweden. They are very much in the news, but with all sorts of other public service to his continental Europe. Dr. Bremmer, I want you to brief in here before we get to Carl Bildt. There is an understanding of Finland and Sweden on down to Turkey, this border which you've talked about at Eurasia Group for years. What is that border, that Eastern Front, whatever you want to call it, what does that view look like from a rogue state of Moscow? a rogue state of Russia?
Yeah, well, it looks a lot worse if you're a rogue state. If you find the present global order unacceptable, and if you find that you're being humiliated through acts of your own, and trying to get yourself into a better position. What it means is that NATO is seen as aggressive. It is expanding. It is more forward deployed. And Ukraine, a non-NATO country, increasingly has the best supplied, best deployed, best trained, best intelligence of any military, best capacity of any military on the ground in Europe. It could not have gone worse for former President Putin, and that border only looks more problematic when you, as Russia, do not have any military strategy to countenance it in 2023.
A good summary from Eurasia Group there to go to Carl Bildt, again, the former Prime Minister of Sweden. Mr. Bildt, thank you so much for joining Bloomberg Surveillance today. Carl Bildt, how alone is Vladimir Putin?
I think he's increasingly alone. I think we should understand that the decision that he took on February 24th last year to launch this particular war was a decision taken by him. I think it was a very, very closed circle around him that was fully aware of his intentions. And of course, that decision was then grudgingly accepted by a lot of the Moscow elites, however you phrase that, in the belief that he would actually succeed. But what has been happening since then is, of course, that he has gradually failed with the one part of the strategy after another. And that means, in my opinion, that he is increasingly isolated in Moscow without that necessarily being an active opposition as of yet, but a lot of uneasiness around him.
Carl Bildt, the tension that Mr. Putin enjoys and likes is, say, personified in your Sweden and Turkey. The distance from Sweden to Turkey has been noted throughout this war. How do the allies coalesce around one voice? What is the process this year to rebut this rogue state?
Well, I think the last year has been, and I think you'll see continuation of this year, very impressive in terms of European action, solidarity, and transatlantic bonds. I don't think, or I'm fairly certain, that Mr. Putin had not counted on that. He had counted on the Americans not being too engaged following what happened in Afghanistan. He had counted on the Europeans being divided, which sometimes happens. And he had counted on the Ukrainians not being too vigilant in supporting their independence. On all of these counts, he was fundamentally wrong. And now he's gradually paying the price.
What do you need from President Biden, from Secretary of State Blinken, from a new American, particularly with the American politics that's new here into a presidential campaign? What do you need from America to steal for a long war?
Well, the continued American support, both in political and military and financial terms, is very important. The European and American support is now roughly equal, but on the military side, the American support is, of course, much more important. And the political leadership that has to be given by the president and the White House has been important in order to mobilize global opinion. And we sincerely hope that that will, and there are no indications to the contrary, that that will continue to be the case during this important year that is now ahead of us.
Ian Bremmer, we deal with someone there who's just still in the pragmatic reality of European politics. I want to dovetail that with a new movie that's coming out, All Quiet on the Western Front, another treatment of a classic book, a classic movie from another time. How can America assist Europe if a large part of America really doesn't want to be involved in Europe like we didn't want to be involved in 1913?
Look, the first American LNG is making its way to Germany today. The United States is doing an enormous amount. They're by far the biggest military supporters of Ukraine in the world today. And American technology companies are by far the most important national security supporters of Ukraine in the digital space, in the cyberspace, in the virtual space. That's enormously important too. That's not being paid for by the American taxpayer. Now, you put all of that together, the risk in 2023 is not that it falls apart. It's not going to fall apart this year. The risk is that Putin increasingly losing on the ground from a national security perspective, a military perspective, an economic perspective, and a diplomatic perspective, with no friends, becomes like a global Iran. He is the most dangerous, most powerful rogue actor that the planet has seen in your and my lifetimes. And his willingness to go after NATO to use asymmetric attacks when nothing on the ground or even in the air increasingly works against a well-defended Ukraine. That's the risk for 2023.
Did Donald Trump get out front of this by questioning NATO and their commitment to their investment in NATO? Was Donald Trump ahead on this?
He helped Putin believe that there would not be a united response. Trump's America First helped lead to Macron's more rhetorical strategic autonomy for France and saying that NATO was brain dead. If you're Vladimir Putin, after 4 years of Trump, you increasingly believe, for reasons that Carl mentioned, that the United States and the Europeans wouldn't care about Ukraine.
We need to consider this further here. Carl Bildt, thank you so much for joining us, the former Prime Minister of Sweden. We'd really like to get you on surveillance again here in the coming weeks as this story unfolds. John, I saw the news over the weekend, or really overnight almost, on Ukraine's attacks on troop levels in Russia. And again, this war may be off the radar. No, this war continues.
You remember, Tom, 9 months ago, we were talking about maybe it lasting a couple of months, and here we are, staring down the barrel of another year of it in 23. TK, great to catch up. We'll catch up with you, I think, in about 30 minutes' time. Looking forward to that. Surprising last year for me. Lisa, Brent crude only up by about $8 a barrel on the year after everything we saw take place.
Yeah, everybody was a bull except for Citigroup, and Citigroup was correct, at least in terms of the scope of bullishness. What does that mean for the why? Are people really traveling that much less? I mean, if you go on the roads, if you go in the airports, does it feel like people are actually less mobile? It doesn't feel like that to me at all.
Q4, do you want the forecasts for this year on crude? Q4 23, WTI, the forecast, the median is $77 based on our survey. Brent crude, the forecast is about 81. Q4 23. You can find that on CPFC on the Bloomberg terminal if you are a subscriber. So, Lisa, basically what we're saying based on these forecasts, the median for whatever that's worth, is that crude's going to end the year basically where it is right now. Does that add up? I want to find out what happens with China. I mentioned this a couple of times. So you've got China on the supply side. I think there's a real conversation to be had about whether we get further dislocations because of the demand or whether you get supply chain relief. Look to Apple and what's happening with Foxconn overnight. On the demand side, where does the demand show up? Have they stockpiled enough commodities through 2022 when demand was softer to maybe avoid that big kick higher in prices this year when China really gets going?
Once upon a time, it was like a couple months ago, we were talking about how weather would actually matter a lot.
It does in Europe, sure.
It has mattered a lot, and I feel like we're not talking about it enough. And how much is weather the reason why gasoline prices, or oil prices, or natural gas prices are where they are, where you're seeing the big plunge? And how much could that reverse if that changes, right? I mean, this is the question. Where is the peripheral demand? China comes back online, a little bit of cold weather. How quickly do things rebound?
Live from New York City this morning. Good morning. That conversation is going to continue. Equity futures on the S&P 500 roll over just a little bit. We're positive 0.4%.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist. And I think we are witnessing right now a societal change in the way we work. You're no longer going to measure productivity in the same way as in the past. You're going to be focusing on output. Never mind what people do in their private times. It doesn't really matter to a company as long as the output is there.
HPE launched its Edge to Office hybrid work initiative in the fall of 2020. The new campus is designed with that flexible model in mind.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Could continue to be pretty challenging for stocks.
Fixed income is back in 2023. You don't have to go out 10 years.
Q1 will be lumpy and bumpy, and I think China's reopening is not going to go as smoothly as people think.
As we move into 23, we're going to start the year with a coupon.
All in all, wages are likely to rise faster than prices in 2023. So I think the purchasing power is going to be there for consumers.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Hello 2023, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures positive by about 0.4% off session highs. Economists lining up to call for a recession in the year ahead, Bramo. Really warm, fuzzy stuff, isn't it, going into the year ahead? And get long bonds. You heard it again and again and again in that opening sequence. Bonds are back.
Which kind of makes me, and I know that this is kind of counterintuitive, but I'll feel a little bit more optimistic. And I know that that's really strange, but you know, you have to think that if everybody's expecting Armageddon and you're getting better than expected data and you aren't seeing some of the worst case scenarios, does that actually mean you can lean against that at least for a couple of months?
A tweet of the morning so far. Do you want to hear it? Why does Mama Bear sound so bullish on the first trading day of the year?
Well,
I wonder who that tweet
is
about this morning.
Look, I'm looking at all of this, and you see better than expected outcomes when it comes to a warmer than expected winter, when it comes to a reopening in China that, yes, is messy, but you're starting to see that mobility data change. How does that really counter some of the real bearish narratives, especially when the consumers are still spending, when you're still seeing wages going up? How much does this really create a complicated narrative that goes against some of the consensus
We get an early look a little bit later this week about some of the data. Through this week, get a ton of it. Then you get payrolls on Friday. Then on to next week, just your guide into the rest of the year, I guess. On to next week, we get CPI next week on the 12th. JP Morgan earnings kicking things off on the 13th. Then you get that first Fed decision, starts at the end of this month, that meeting, the decision on the first day of next.
I'm curious to know the balance of risks when we get that CPI report. Do markets respond more violently to a downside surprise or an upside surprise, right? This idea that perhaps inflation isn't coming down as quickly or is coming down even more quickly than people expected. What does the Fed do with that? We're not expecting Fed rate hikes, but do we start talking about potentially a lower terminal rate in a more concrete way?
Neither of us have the answers, but let's ask the right questions, and you're going in that direction. We've had the conversation about how high at the Federal Reserve. Conversation shifts now to how long do we stay there once we get to, say, 5%, if we even get close to that level? How long do we stay there? Because when it comes to inflation, yeah, peak inflation, sure, done. Cool, whatever. Come down to what? 5 and stay there for how long? How sticky is this story going to be? Is it too early to move on and say, yes, 23 started, line in the sand, arbitrary date, I'm done with looking at inflation, now I'm going to look at growth? That's kind of the story that's being sold on the street right now, isn't it?
And I'm going to be a little bit counterintuitive here and say, how much does this really depend on oil prices? How much are people going to look back on 2022 and say it was a commodity boom that people mispriced and that faded in 2023? Or does it not? Does it actually rear its head, especially with China's reopening?
Equity futures right now, positive by a third of 1%. For those of you just tuning in, just waking up perhaps, we were much higher than this about an hour ago. We were higher by about 1%. So equity futures might be positive now, but they have been rolling over, at least for over the last 30 minutes or so.
You have to wonder what liquidity is doing, especially with such a big move in bonds. I suppose that the equities have gotten with the bond story, which is the bid into bonds, tends to be gloomier. So I guess people are fading. I'm not going to give it a narrative. Who knows what's going on here? It's the first trading day of the year in the United States. We're looking at this week, Wednesday, you get U.S. job openings data. I'm really curious to see how quickly the number of openings per each employee in the United States keeps coming down. We know it's been incredibly inflated. Is this a sign of early loosening in a labor market that has been ultra tight? Thursday, we get ADP employment data at 8:15 a.m. Initial jobless claims at 8:30 a.m. We have seen really very little increase in the people filing for jobless benefits. Is this something idiosyncratic about the nature of the employees laid off, that they're getting severance bonuses or that they're getting some sort of gardening leave? Or is this simply, again, that this is a market with far too few workers for the jobs that are needed to be done? And Friday, we get the real read on the employment picture in the United States, 8:30 a.m., non-farm payrolls. How much do we see average hourly earnings continue to expand? Do we see a deceleration in the pace of that? If not, what does that tell us, right? How do we interpret that data at a time of really convoluted messaging with respect to the services side and the goods sides of the economy?
Can we just ban one chart early in 2023? Jobless claims over 5 years. The pandemic broke the chart. The chart's just useless now.
Well, it's useless.
It's useless.
It's not useless. I disagree. We can debate this.
Why is it useful?
It's useful because